I think it's yours going up here. Yours already there. So, yeah. You say right next to it. Oh, right. Right. Right.
Yeah.
Up to 40 at least to be. I really think that's how I would experience it. I'm not something that's gonna hold me, just. But you are, I guess that brings someone. Because. So in case we do call you out, let's bring this up to my time. Okay.
Good, are you? Good.
I think it's a quick.
Are you? Not bad. Is it?
Well.
Is your beer? How you doing? Good. Who's-
All right, good morning, everyone, and welcome to docket number 240103, PURA's annual review of the rate adjustment mechanisms of the Connecticut Light and Power Company. We are here this morning for an evidentiary hearing in this matter, and we have an agenda in front of us today. The first thing I want to do is take appearances, so I'm aware of everyone who's here today. I'll start with the company, please.
Good morning, Commissioners. Vincent Pace for Eversource Energy.
Good morning, Kathleen O'Hare for Eversource Energy.
Good morning. Attorney McCorney.
Good morning, Chair Allison McCorney for the Office of Consumer Counsel.
Thank you. Anyone else? Oh, good morning, Attorney Inoue. Thank you. Anyone else? Very good. Okay, so we're going to begin with any administrative matters followed by adoption of pre-filed materials. Are there any administrative matters this morning? Okay. Okay, Attorney Pace, I am going to propose that we swear in your witnesses as a panel. Is that okay?
No objection. Thank you. That's very efficient in light of the large group we have here today.
Very good. Okay, so are there any witnesses in the audience? Okay, can you just approach the mic for me, sir? Is it Mr. Bajan? Okay, very good. And all the other witnesses are at the table or behind?
Yes, that's correct, Chairman.
And okay, and you are, sir?
Yeah, David Glady.
David Glady, thank you. And you are, sir? Brendan O'Brien. Okay, very good. Then if each of the witnesses can please raise your right hand. I'm going to administer the oath, and at the conclusion of the oath, if you can please say, I do. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury. Okay, very good. So for purposes of our court reporter, if you're not sitting at the table with your name tag clearly displayed and you need to answer a question, if you could please approach the mic, any mic, and have your name tag visible. Attorney Pace, can you please have your witnesses adopt the pre-filed materials?
Yes, I will. We're going to proceed in alphabetical order. So starting first with Mr. Bajan. Mr. Bajan, could you please provide your full name and title for the record?
Bertie Bajan and call center.
And in connection with this docket, did you sponsor one or more interrogatories? Do you have any modifications at this time? And do you adopt those materials as your sworn testimony under oath? Next to Mr. Bruno. Mr. Bruno, please approach a microphone and identify your full name and title for the record.
Good morning, Stephen Bruno. Good morning, Stephen Bruno, Director of Business Operations, Eversource Energy.
And Mr. Bruno, in connection with this docket, did you sponsor one or more interrogatories?
Yes, I did.
Do you have any modifications or changes at this time?
No, I do not.
Do you adopt those materials as your sworn testimony under oath?
Yes, I do.
Thank you, Mr. Bruno. Next to Mr. Davis, please approach a microphone, identify your full name and title for the record.
Good morning, Edward A. Davis. I am the Director of Rates for Eversource Energy.
And did you sponsor interrogatories in this proceeding?
Yes, I have.
Do you have any modifications at this time?
I do not.
Do you adopt those materials as your sworn testimony under oath?
Yes, I do.
Thank you. Next to Mr. Glady, please approach your microphone and identify your full name and title for the record.
Yeah, David Glady. I'm the Vice President of Distribution Engineering for Connecticut.
And Mr. Glady, did you sponsor pre-filed testimony in this proceeding?
I did.
Do you have any modifications at this time?
I don't.
Do you adopt that testimony as your sworn testimony under oath?
I do.
Thank you. Next to Mr. Horton. Mr. Horton, please provide your full name and title for the record.
Doug Horton, Vice President of Distribution Rates and Regulatory Requirements for Eversource.
Did you sponsor both interrogatories and pre-filed testimony for this proceeding?
Yes.
Do you have any modifications at this time?
No, I don't.
Do you adopt those materials as your sworn testimony under oath?
Yes.
Next to Mr. Kalen, please approach a microphone and identify your full name and title for the record.
Jonathan Callan, Manager of Financial Analysis.
And Mr. Kalen, did you sponsor pre-file testimony?
Yes.
Do you have any modifications at this time?
No.
Do you adopt those materials as your sworn testimony under oath?
Yes, I do.
Okay, next to Mr. Matthews. Mr. Matthews, please provide your full name and title for the record.
I'm Jim Matthews, Manager of Transmission Rates and Revenue Requirements.
And Mr. Matthews, did you sponsor both interrogatory responses and pre-file testimony?
Yes.
Do you have any modifications at this time?
No, I do not.
Do you adopt those materials as your sworn testimony under oath?
Yes.
Thank you. Next to Mr. O'Brien. Mr. O'Brien, please provide your full name and title for the record.
Brendan O'Brien, Director of Revenue and Regulatory Accounting at Eversource Energy.
Did you sponsor interrogatories in this proceeding?
Yes, I did.
Do you have any modifications?
I do not.
Do you adopt those materials as your sworn testimony under oath?
Yes, I do.
Next to Ms. Peruta. Ms. Peruta, please provide your full name and title for the record.
Good morning, Marissa Peruta, Director of Connecticut Revenue Requirements for Eversource Energy.
Did you sponsor both pre-file testimony and interrogatory responses?
Yes, I did.
Do you have any modifications?
I do not.
Do you adopt those as your sworn testimony under oath?
Yes, I do.
Our next witness, Mr. Ghani Ramadani, did not sponsor pre-file testimony or interrogatories. I'll therefore proceed to the next name on the list. The next name on the list is Laura Purbeck, who's going to be adopting interrogatory responses on behalf of Brian Rice. Mr. Rice could not be here today. Ms. Purbeck, please provide your full name and title for the record.
Good morning, Laura Purbeck, Operations Manager of Renewable Programs.
And are you sponsoring the interrogatories originally sponsored by Brian J. Rice, Director of Customer Solar Program?
Yes, I am.
Do you have any modifications to those materials?
No, I do not.
Do you adopt those as your sworn testimony under oath?
Yes, I do.
Thank you. Next to Mr. Rogan. Mr. Rogan, please provide your full name and title for the record.
Peter Rogan, Manager, Wholesale Power Contracts for Eversource Energy.
Mr. Rogan, did you sponsor interrogatories in this proceeding?
Yes, I did.
Do you have any modifications?
No, I do not.
Do you adopt those as your sworn testimony under oath?
Yes, I do.
Next to Mr. Shelnitz, full name and title for the record.
Good morning, Michael Shelnitz. I'm a Manager of Revenue Requirements for Connecticut for Eversource Energy.
Did you sponsor both pre-file testimony and interrogatory responses?
Yes, I did.
Any modifications at this time?
No.
Do you adopt those materials as your sworn testimony under oath?
Yes.
Next to Mr. Thompson, full name and title for the record.
David L. Thompson, Manager of Rates for Eversource Connecticut.
Did you sponsor both interrogatory responses and pre-file testimony?
Yes.
Do you have any modifications at this time?
No.
Do you adopt those materials as your sworn testimony under oath?
Yes.
Next to Mr. Trainer, full name and title for the record, please.
My name is Daniel Trainer. I'm the Director of Collections and Low-Income Programs for Eversource Energy.
Mr. Trainer, did you sponsor interrogatories and pre-file testimony both in your name and in the name of Jessica Kane?
Yes, I did.
Do you adopt those materials as your sworn testimony under oath?
I do.
Thank you. And finally, thank you for hanging in there. We're on our last witness. We have Mr. Toronto. Mr. Toronto, full name and title for the record.
Jeffrey Toronto, Manager of Investment Planning in Connecticut.
And Mr. Toronto, did you sponsor pre-file testimony both in your name and in the name of Leanne Landry?
Yes, I did.
Do you have any modifications at this time?
No, I do not.
And do you adopt those materials as well as Ms. Landry's materials as your sworn testimony under oath?
Yes, I do.
Thank you. Thank you for your patience, commissioners, and letting us get through that long list. We've concluded it. Thank you.
Thank you, Attorney Pace. The panel is available for cross-examination.
Yes, Chairman.
Very good. We will begin with a cross-examination by PRS staff. We have Mr. Norton up first, please.
Good morning, Jonathan Norton with Authority Staff. I'm going to be handling just a few questions regarding the NBFMCC and specific questions as well around full-time equivalencies. I don't think I'll be a full half hour. So starting off, I'm going to make reference to the March 1st filing, rate application filing Exhibit F on page 2. So I'm looking at page 2 of Exhibit F. I was looking at row 31 and 32, specifically for the Millstone and Seabrook PPAs. My question is, can the company explain how or why the Millstone PPA produced a significant net cost, while Seabrook maintained a slight net benefit in 2023?
Sure, the price, underlying price of the PPAs are fundamentally different. They're almost $10 a megawatt different, per megawatt hour different. So in general, the Millstone cost of that PPA is about 5 cents or $50 a megawatt hour, where the Seabrook contract is about $10 per megawatt hour less.
Okay, thank you. On the same page 2 of Exhibit F, can the company provide an explanation for the approximately $19.3 million increase to the Project 150 EPA's line item? I believe that was line item 34.
The Project 150s. Let's see.
Can you repeat the page number again, please?
Yes, it's March 1st filing, Exhibit F, page 2. And I'm on row 34 is what I was looking at.
Page one here. The increase in cost on the Project 150 was due to the return to service of one of the main projects, Plainfield Renewable Energy, which was out during a great portion of 2022. And it returned to service in 2023. And that's a very expensive contract, and that accounts for the increase in cost, the large cost there.
Okay, thank you. Additionally, row 37 of the same filing, there was a significant $14.6 million increase year over year in regards to the contracts for differences. Can the company give an explanation for that increase year over year?
The There's two primary reasons for the increase on that. The contract for difference with Clean is a function of the clearing prices for capacity in the ISO New England market. So to the extent the capacity price goes down each year, you would expect a higher net cost on that contract, and vice versa. If the price increased, you'd see a decrease on that, but the prices did drop. The other one had to do with the PSEG New Haven peaking contract, which is part of a we call it a mini rate case, where PSEG comes in here and they had an increased revenue requirement. So that would account for the increase on those.
Thank you. I'm going to move on to the full-time equivalencies, specifically in reference to interrog response CAE2. And the chart that the company provided in response to that interrogatory. Just have a few questions here. I'm going to start off on the energy storage ESS program. My first question, it looks like there's a significant uptick in 2024 involvement, or expected uptick in 2024 involvement for the ESS program. Can the company just provide an explanation as to why that is for the record? I can restate the question if you need.
I'm good. I'm good. Thank you. Appreciate it. Essentially, the program in 2022 started to ramp up. So as we get more contracts into the program for customers, residential, and commercial industrial. We expect the labor to enroll them in the active demand response programs to increase. So it's basically due to program ramp up. Right now, there's mostly customers in the pipeline, and then as Green Bank enrolls them into the program, then we take them afterwards and put them into the active demand response program. So it's labor associated with customer enrollment.
Okay, thank you. And for separately for the IES program listed in this chart, it looks like two analysts listed are shown showing an increase from 0% to 100% expected in 2024, but they're not specifically marked as new employees. Is that right?
Correct. We've been managing that program to date. It's been primarily in this program setup as well. So we've been managing it with incremental FTEs, and then we expect as the contracts which were approved by PURA this year in 2024, as those contracts with the developers that are building the pilot programs, as those contracts get off the ground, we expect more labor to support the contracts. So the last basically year and a half has been program startup, working with Stratagen, the consultant, issuing the RFP for companies to bid into the pilot program. And so we expect this year with the signed contracts, the labor to support that increase.
Okay, understood. Thank you. Looking at the last four rows of the chart for the LREC, ZREC, and NRES programs, it shows 2023 involvement at varying percentages, but says these are new hires for 2024. Can you just provide clarification on these roles?
Which rows of the chart specifically?
The last four, so that would be senior staff accountant, LREC, ZREC, staff accountant, LREC, ZREC, and then same thing for the two NRES at the bottom, the last four.
Okay, so we expect, since the LREC ZREC program has been winding down, that the involvement of those staff members in the LREC ZREC program will decrease, and they will increase their involvement in the NRES program.
Is just curious why they are listed as new for 2024 there. Is that, am I missing something there? Under the column new FTE in 2024,
Oh,
it
okay.
says yes.
Yes, I believe that's just to explain that they would be, that their time would effectively be charged to the NRES program, while moving off of being charged to the LREC ZREC program.
Okay, so these aren't new employees then?
They're not new employees to the company. They just would be allocating their time to a different program.
Gotcha. Thank you. Of the list of newly hired FTEs for 2024, can the company confirm if any of these positions have been hired to date?
For everyone in the chart, or are you just referring to LREC ZREC and?
Well, based on your last answer, I guess I guess your explanation kind of points to the fact that just because it says yes for new FTE in 24 doesn't mean it's a new employee for the company. But I guess what I'm trying to get at is, of this list that was provided by the company, I guess my first question is, what number of them were actually new hires? And then my follow-up would be, how many of those have been actually hired in 2024 yet?
So as it pertains to LREC ZREC and NRES, they were not employees that were specifically hired this year to support those programs. Again, they were previous employees who were hired for the renewable programs in general, being LREC ZREC, and then they are now applying their time to the NRES program. But they are not new employees that were just recently hired.
Same story for the IES program and the ESS program, no new employees.
How about, can someone answer for RRES and I see SCEF and a project manager under the NRES program. Would those be new employees or existing?
For the SCEF program, there was a new employee, a new analyst that was hired in 2024. The RRES program, to yep, I'm gonna have to take that back and confirm if the customer service analyst was hired or not.
And Chairman, what we could do if it's acceptable to you is I know there's no late file hearing, but if we'd have latitude to be able to submit a written supplement to the data response in a time frame that works for the authority, would that be an acceptable approach to get the information into the record to respond to Mr. Norton?
It would be, thank you. And are we still on CAE two?
That's right. Yeah.
Okay, so, and Attorney Pace, if you can help me remember to set a time for the supplements at the conclusion of the hearing.
Thank you.
Thank you.
Actually, I can confirm that all positions for RRES and NRES have been filled except for one full-time employee for SCEF.
And just to clarify, does that answer Mr. Norton's question? I just want to see if we can avoid a written supplement. We're happy to do that as long as he's satisfied with the response he has.
Yeah, I think that satisfies it. So everything other than the ESS, the IES, and then those 4 rows at the bottom, LREC, ZREC, and NRES, are new hires, and all of them have been hired except for SCEF, you're saying?
That's correct.
Okay. Yeah, I'm all set. I'm gonna move on. Just have a couple questions in regard to the NRES and SCEF program. Referring back to the company's March 1 filing, Exhibit F again, but page 3 this time. It shows the NRES program and the SCEF program total 2023 costs of $454,000 and $687,000 respectively. And my questions here, can the company provide an explanation for the drastic increase that it's expecting from $454,000 incurred in 2023 for the NRES program versus the company's known and measurable filing for 2024, which amounted to about $7.35 million?
Certainly. So the increase would be new projects coming online, projects going in service, and Eversource paying for those contracts, for the energy and renewable energy credits from those contracts, along with increased labor to account for the programs.
Does the company have an estimated number of projects that are coming online in that program?
I'm not sure if we estimated the number of projects. We can supplement with that response. I'm not sure if we included that in our.
No, I think I don't necessarily think we need that. That's okay. My follow-up would be, I mean, I assume it's a similar answer here, but on the SCEF program as well, just noticing that the known and measurable that the company filed was up near almost $4.5 million for 2024 versus the $687,000 incurred in 2023. I guess same question, assuming the same answer.
Yes, it is the same answer. It would be expecting projects to come online this year and then the staff to manage those agreements as well as the customer enrollment on the SCEF side.
Okay, just a moment. Okay, thank you. I only have one more question. And this one is, just a high level question, without detail behind this question for CAE 13. And the question, really, just one clarifying question on the number provided by the company in that response. Can the company just confirm whether the GSC adder is included in that number?
Yes, it is included in that number.
Okay, thank you. That concludes my cross. Thank you.
Thank you, Mr. Norton. Ms. McDonald, please.
Morning panel, Karima McDonald with Pura staff. My first couple of questions is just of an administrative nature. Can you direct me to the accounts receivable charge-offs from January through December with the breakdown of the hardship versus non-hardship?
Could you just clarify the term charge off? What are you referring to?
Your
Write-offs?
uncollectibles from January through December.
The uncollectible expense?
Mhm.
Yeah, I think that balance is approximately 103 million that's shown in Exhibit H.
Yeah, but I don't have a breakdown versus medical hardship. Where's that filing?
I don't know about, that was broken down individually between those two components in the filing. It is shown monthly, but I don't believe that's broken down between the financial
different
hardship and.
There is OCC 4 that does have the 103 broken down with 83 million for financial hardship and 20 million for medical hardship.
All right. Thank you, Mr. Trainer.
You're welcome.
And next one, can the company clarify the total actual expenses for 2023 for me? Is it the 164.22 million or the 164.345 million?
Can you just reference where those numbers are?
In your 215 filing, it reports in Exhibit H, 164.22 million, 220. And then in your Exhibit 6, in your March 1st filing, that's where I'm seeing the difference. Which presumably includes the cost for review officer.
The difference is related to the review officer cost that we removed.
So the actual figure is what was reported then in your 215 filing?
And I apologize, I'm having technical difficulties. I can't get to the number exactly. If you give me just 1 minute.
All right, we can circle back to that then. I'll move on until, just let me know when you've found that.
I can confirm, Ms. McDonald, it's the March 1st number.
The March 1st number? But
Correct.
That includes the review officer costs.
It does not. It's excluded. We will confirm that as soon as I get myself back online.
Okay, all right, thank you. All right, Exhibit H-10, the data dashboard. I just have a few questions there. Uh, Let me know when you're ready.
I'm sorry, what exhibit was it?
H dash 10.
Yep.
Data dashboard.
Thank you.
Can you confirm that this implementation was a joint endeavor for both the electric and gas companies?
Yes, that's correct.
What was the total cost for the endeavor and how were the costs distributed between the companies or among the companies?
I don't have the split breakdown in front of me. So I'd have to get back to you on that and supplement that response.
Can you confirm then that what's reported here is the total cost for CLMP?
That cost in December was a UVL for the cost that we estimated. We didn't get the invoice till January. It was the actual invoice was 125,000.
So you're sure, is that an increase then to what was reported, so 105?
105 was in the exhibit, yes.
And now it's 125?
Yeah, and we outlined that in it's CAE 32.
All right,
Break down those costs.
thank you. Is that a one-time or recurring cost?
That cost, the 125,000, is a one-time cost for the implementation. For the costs experienced in 2023, there are costs on a yearly basis going forward, and some cost for January 2024 as part of the implementation as well.
And that's also reported in CAE 32?
CA 32 is the breakdown of cost for 2023 only.
For 2023 only, okay. Thank you, Mr. Schreiner.
Can I just clarify for the record? I know during the exchange, there was a discussion about a supplement. Does Ms. McDonald have what she needs on that topic, or do you need something further?
Thank you, Attorney Pace. No supplement is necessary.
Thank you.
Exhibit 25.
Go ahead.
Could you provide some more details about the allocation of this 160,000 for the call handling time, please? And how was this figure determined?
Bring up Mr. Bajan. Help with that.
Can you repeat your question, please?
Could you provide more details about the 160,000 that's reported for the call handling time in December? And how was this figure determined?
Sure. So the $160,000, it's an estimate. And the way we came up with the calculation was we had provided certain talking points to the CSRs to explain the low-income discount rate in its entirety. And based on that, we went back and assumed a certain amount of time, which would have been added to our call handle time. Now, I also responded back to the actuals for the low-income discount rate in CAE 7.
All right, thank you.
So what we did further to compare the assumptions with the actuals, we went back and looked at our average handle time for same time last year, and we saw the comparison and our overall average handle time from December of 2022 to 2023 increased by 105 seconds. And the change to that was the orders that we had received, not only for the low-income discount rate, but also for the residential renewable energy and energy storage. And also what we did was we did a time study. We took random calls, we listened to the calls, and we saw that 74 seconds were coming up because of the low-income discount rate. and 54 seconds were related to the RES and ESS. And based on that, the increase of 105 seconds was amounting to around 32 FTEs increase.
Thank you. CAE 22, please. Can the company explain what is included in the line item entitled Low Income Special Needs Programs? In that response, please.
Yeah, so the low income special needs program relates to mostly outreach to low income customers for our programs, matching payment program, New Start, and the likes, letters usually.
Okay, and so what's reported here then, is that just for the LiDAR, or does it include costs for other system programs too?
It's related to, let me double check that. It's just LiDAR.
Just LiDAR.
Yep.
All right, thank you. For the IT capital revenue requirement, is that a one-time or recurring cost?
The actual capital investment on the LiDAR IT project was a one-time cost. However, the way that it flows through the rate, the SBC rate, it comes through annually over the life of the asset itself as it's being depreciated and amortized through the rate. So this is the first time you'll see it, as LiDAR was just implemented last year, but it will flow through the SBC rate going forward until it is fully amortized.
All right, thank you, Ms. Baroto. My final question is related to the response to CAE 24. First, did the company apply the gross earnings tax savings to the numbers reported for LiDAR in December?
When you're talking about December, are you referring to CAE 23?
Yes, the 2.6 million that was reported in Ms. Peruta and Ms. Shelnitz's pre-filed testimony.
Yes, the get credit was applied there because the actual discounts applied to customers was about 2.7 million.
All right, thank you. All right, I'm going to request a supplement to this response with the actual enrollment figures with February up to perhaps March 8th.
I have March 15th ready for you if you want that.
Perfect. I didn't want to push it too much.
So you're looking for the number of customers enrolled in the program as of March 15th?
And the total cost, and if possible, the GET savings as a result.
Yeah, we'll take that as a supplement. I don't have all of that on.
You were gonna break it down for me
Yeah, we'll
in
break it
tiers. And can I have it by Wednesday, or am I pushing it? All right, perfect,
Can I confirm that was a supplement to CAE 24? Is that correct?
correct.
Okay, thank you.
Before I go, Ms. Peruta, can you confirm the total actual expenses for me for 2023?
And just the LiDAR discount, correct?
No, the total actual expenses.
For LiDAR?
No.
No.
For everything, for the company for 2023. in your 215 filing, I'm seeing a difference between what's reported in your March 1st filing.
On your SBC, yeah, so for March 1st, yes, correct. The March 1st total actual SBC rate expense is 164,228.87.
That's not what I have in March 1st, but you're saying that's the number? That's what I have in the 215 filing.
We are looking at the March 1st filing.
I have 164.345. Regardless, what is the correct number?
It is the 164,220, yes, because it should appropriately remove the review officer cost that was accidentally included in our rates filing as filed on February 15.
All right, thank you.
You're welcome.
That's all I have, Chair.
Thank you. Mr. Capozzi.
Chairman, Commissioner, good morning panel, Steve Capozzi with Authority staff. I have a few questions on the electric systems improvements charge. Can you please turn to Exhibit AAESI? And let me know when you're ready.
If we could have Mr. Toronto and Mr. Glady approach. Thank you. Does the CLMP panel have the data response or exhibit ready? Okay, thank you.
That was AA2.
Thank you. Can we turn page 3, please, and turn to line 26? So the 2023 core capital row includes expenses for May through December. Is that correct?
Those would actually be revenue requirements associated with January through August, but they're shifted by 4 months to line up with the implementation of base rates back in the settlement agreement.
That's right. Thank you. So you anticipated my next question. So the expenses for May were for plant additions in January, correct? As an example?
Correct.
Okay. Excuse me, I just closed out of my browser, so you'll have to wait 1 minute. Okay, so our actual expenses for 2023 capital additions for actual months, September, October, November, and December, not included in the 2023 actual expenses row? Or anywhere in this?
Correct. They're not in this schedule. However, they are in the known and measurable filing as an adjustment there.
Okay. Okay. Now I want to move down to line 50. Can you step through line 50, column R, Excel column R? Can you step through how the company calculated the mitigation carrying charge for carrying cost adjustment.
So, what we did is we ran two separate calculations. One that, so the mitigation that was proposed in the prior year was one that extended the recovery of the ESI under recovery for from 12 months to 24 months. And so what we did is we ran a calculation as if it recovered the full amount over 12 months and did a similar calculation as if it recovered the amount over 24 months, compared the two, and that produced the resulting change in carrying charge. And for the months included in this filing, we included that as an adjustment.
Okay. Is that calculation where you had done that anywhere in these filings?
No.
Okay. Is that something you could provide?
Yes, absolutely.
Okay.
Mr. Capozzi, are you asking them to supplement, what was that, RSR?
This is the March 1st filing, Exhibit AA ESI.
Okay, so the request is to supplement the March 1st Exhibit AA ESI filing with the calculation reflected.
Yeah, reflected on page 3. Or the mitigation carrying charge calculation.
Can I ask Mr. Sheldon, is that clear in terms of what's being requested?
Yes, it is.
Thank you.
Yeah.
Okay, so shifting gears just a little bit. So ESI and all the components that are in it are treated sort of as their own rate base that runs in parallel with the company's rate base and their base distribution rates. Is that a correct understanding?
I wouldn't characterize it as rate base. I would characterize it as the plant additions associated with the capital that was spelled out in the settlement agreement.
Okay. Are the calculations that are the expenses that are determined from those plant additions done the same way as the company would do their base distribution rates for the same type of expenses?
I'm not sure I understand the question.
So if you have, let me see if I can rephrase. In determining the expenses that are, that the company would include in their revenue requirement from plant additions, are you essentially doing the same thing in the ESI, for the ESI plant additions, as you would for plant additions and base distribution rates?
I think at a high level, the answer would be yes. I mean, if you look at the revenue requirement calculations that are part of the calculation, you can see the depreciation factor that we're applying. You can see the deferred tax factor that we're applying. So those are all the same as the averages that would be in a base rate case.
Okay, so you depreciate the plant in the same or similar way, the same way?
Yes.
Okay. And that plant gets
Using the average depreciation rate from the rate case.
Okay. And the plant in both instances, base distribution rates and through ESI, also there's a return for that on that plant as well, and done the same way using the same rate.
Yes.
Okay. And done the same way.
Yes.
Okay. Is there a difference somewhere between how you're determining the expense that goes into the revenue requirement from ESI plant additions versus base distribution rate plant additions?
Well, I would just say that, in a distribution rate case with the calculation of a test year, You have you're picking up the actual expenses that are going through the accounting records to put together those test year expenses. Here, we are just doing a calculation based on the allowed factors from the rate case. So that would be the primary difference.
Okay. All right, thank you. So in prior general rate amendment applications filed by the company, so I'm referring to docket 171046, docket 140506, and forget the docket number of the other one, the prior one.
I think it's 09-1205.
Thank you.
Thank you.
09-1205 has the company ever had, so at the time of the filings of those rate applications, unrecovered plant additions that it's looking to include into base distribution rates that are in excess of what was allowed in the prior rate case? Does that question make sense?
Are you asking at the time of those prior rate cases, presumably we would have had multi-year rate plans in effect prior to that. And then at the time of the rate case, the actual plant additions exceeded that which was allowed in rates?
That's what I'm asking, yeah.
I don't know for sure, but I would imagine, yes, that's a typical process when you have a multi-year rate plan, yes.
Okay. And so as part of that rate application, what the company just seeks to, or one of the things the company seeks to do is to just include those, I don't know what the term is, but include those plant additions that are currently not in base rates into new rates. So they're now included in any rate base calculations for the revenue requirement and so forth. That's one of the things. Is that correct?
Right. In a rate case, we update all components of our rates to reflect our costs. In the past, we've relied on forward-looking multi-year rate plans that would incorporate a forecast, a projection of plant additions over the term of the rate plan.
Okay.
The ESI was a function of the settlement from the last rate case where this was a way for the parties to agree on an amount in base rates, which was lower than we expected. And the ESI allowed us to get recognition and recovery of reliability-based investments above the amount in base rates. And then in the fourth year and thereafter, capped the amount that was recoverable to 300 million, or the revenue requirement of 300 million, despite whatever we're spending above that, which is nearly double.
Okay. In the prior rate applications for those dockets, has the company sought to collect carrying charges on those unrecovered, I'll call them unrecovered plant additions, on those unrecovered plant additions based on, for example, when those plants were actually placed in service? Or has the company just sought to update the plant in service number?
No, in typical rate making for components of base rates, you get for plant additions that had been made prior to the rate year or the test year, there's regulatory lag that's experienced on additions that are expended but not reflected in rates. So there wouldn't be a carrying charge applied because you're not going back in time to recover previously incurred costs. You're setting rates to reflect your actual costs. The ESI, again, was a function of the prior settlement agreement, which provided for recovery of those amounts above and beyond which was in base rates. In the absence of the ESI, base rates would have been set higher than what the ESI or what base rates were set to collect at the time of the last rate case. So these are costs that are incurred on an ongoing basis and should be allowed for in rates through the ESI.
Okay, has the authority ever authorized the company to collect carrying charges in a general rate, in a decision on a general rate case for those unrecovered plant balances or plant additions?
So I think it's apples and oranges. Like I said, in the prior cases when there was what's considered typical regulatory lag, the company would not have requested carrying charges for plant additions made in the past. I'm certain there are times when there were carrying charges applied for other items the company had expended and didn't have timely recovery for in rates. But for capital additions, that's not how things typically work. The ESI, again, was a function of the settlement agreement from the prior case. And so we have had carrying charges applied to the ESI under collections over time.
Okay, so the authority has never allowed the company to collect, or has not allowed company, at least in those 3 rate cases, the company to collect carrying charges on those planned additions?
We wouldn't have asked for it because we wouldn't have been entitled for it, which is different from the ESI.
Thank you, Chairman. Those are all the questions I have. Thank you, panel.
Thank you, Mr. Capozzi. Mr. White, please.
A couple of questions on the NBFMCC. A couple of questions on the NBFMCC IES program. In the 3-1 RAM filing exhibit F28, what expenses are represented by the $14,752?
For 2023, those costs are just employee labor to support reviewing the bids for the program that came through.
Okay, so cost allocation of employee labor?
Yeah, exactly.
Okay. Circling back to some discussion with Jonathan Norton, I just want to try to understand this. I thought, and I may have misheard something, I thought it was said both with regard to the IES FTEs, I thought it was said that they're both new employees and not new employees. I'm wondering, I mean, maybe they were hired in 2023 and you're doing some shifting around as programs are ramping up.
For IES and ESS, there are no new employees for 23 or 2024.
Okay. Okay. And they're so they are not new employees, just wondering how their work is happening. Is this as the program ramps up, work gets shifted around?
Exactly.
Okay.
Just to help out a little bit, the IES program was a program where companies could submit proposals for up to $5 million for pilot programs. And so the prior activity has been just ramping up the program, setting up the structure, working with Stratagen. And then the proposals that were submitted were finally sent for contract for review and approval early this year. So we do expect the cost in 2024 to grow. That's why you'll see the forecasted 2024 program costs increasing.
And that is what I was about to ask.
Yeah.
Next, which is in the 116 pre-filed testimony, the known and measurable, exhibit 18, what does the $402,000 of labor and third-party support costs?
Perfect. Yeah. So the $402,000 of labor expects employee time will be allocated to support this program. So there are customers that are not employees that are not in existing rates that would charge time to this particular program to support the program development and the invoices that come in from the vendors and getting the project set up, working with the utilities. And then the other portion of the costs are actual vendor costs that will submit approval for expenditures. So when the project was approved, let's say a particular program wins a pilot award, they have expenditures that will go through the process.
So just to be clear here, what I was asking about was the $402,000 category 1 costs. And I think what you just were explaining about project costs is the category 2 costs, another $3 million.
Correct. The $402,000 is just employee labor.
It's just employee labor. And this is for 2 FTEs.
2.4. Yeah.
2.4 FTEs. Okay, thank you. How and when are the costs of the of the program manager, Stratagen, allocated to the EDCs?
So right now, I believe Stratagen actually invoices Pura, and Pura invoices the EDCs through a separate contract. They're not charging this directly to this program. So I can do a follow-up, but I believe that Pura invoices the Stratagen costs to an existing docket that Pura has.
Okay. All right.
So they're not. And when we originally developed the program, we had thought that the Stratagen cost would come through this particular program, but I believe that Stratagen is already on a contract with Pura, so they're recovering the cost in a different area for Stratagen.
Okay.
So the costs that we have budgeted in there for 2024 are the actual vendor pilot program costs, not Stratagen.
Okay. You don't happen to know what docket that is?
No, we can try to find out.
Okay.
Just to clarify, do you want that as a supplement into the record?
It's 220807.
Okay.
Got it. Okay.
Thank you, Chairman.
Thank you.
That's it for me. Thank you.
Thank you. Ms. Cohen, please.
Stephanie Cohen, Authority Staff. Good morning to the panel. I just have hopefully a few follow-up questions. If we were on the topic of FTEs under the NBFMCC, I'd like to stay with that. And so pulling back up CAE 2, please. Sorry for the up and down, Ms. Purbeck. So there's a column here that a number of these, the majority, in fact, it looks like of FTEs are existing. In other words, no new FTE in 2024 for a given position to cover tasks associated with the clean energy and grid modernization programs. Is that a correct way to read that table?
Sure, yeah, the concept was we used the table to say whether the employee is an existing employee. I'm speaking for the IES program and the ESS program. And then so whether or not that new employee there'll be a new employee in 2024. So for those two particular programs, we just expect more of time to be charged for those particular roles. They're currently not being charged in 2023 as much as we anticipate in 2024 for IES and for ESS.
Okay, great. But in terms of like on the payroll, are they existing? Are all these listed positions and employees on the CLNP payroll?
For the IES and the ESS program, they're primarily energy efficiency employees that are not in rates.
Well, what about all the other ones that are RES, NRES, LREC, ZREC, SCEF?
Those positions are all recovered under the non-bypassable.
Right. If they're not new FTEs in 2024 and are existing employees, we're just trying to understand the org chart, if you will. So are they currently employees of CLNP that are now getting charged additional percentage of their time to these programs?
No, the employees that are listed here are all incremental employees that were hired specifically for these programs.
They are all new positions that were filled.
They are all positions that are charged under a tracker, if you will. So they're employees that are hired specifically for these programs to run and manage the needs of these programs.
That weren't previously existing CLNP or Eversource Energy employees.
If I could chime in, I think, so I think you're asking if they're not listed under new FTE in 2024.
Right.
Simply, are they CLNP or Eversource employees? And I think the answer is yes. I'm not sure if they're CLNP or Eversource, but they're employed by, but as Ms. Purbeck's, through either prior period decision or legislative requirements in terms of how the costs are recovered and reflected, they were not included in base distribution rates for CLNP and thus are reflected in these mechanisms and have been over time.
Okay, so none of the employees listed on CAE 02 had any portion of their time that was recovered through base distribution rates.
That's correct.
Thank you. I think I have another FTE related question, so let me just, well, not FTEs, but if we could return to CAE 22 and the additional call handle time analysis, please. So thanks for the explanation about how the estimates were provided by the company for, I think, December 2023 and January 2024. Can you clarify if that's internal Eversource personnel or a contracted service for customer service representatives or a combination?
It's our vendor for the credit contact center.
Okay.
Those are the individual Alorica.
Alorica? Okay, so these are total additional incremental costs the company's proposing attributed to a contract with Alorica. Is that a fair way to think about it?
Yes.
Okay.
However, this comes under our existing contract.
Okay.
So, the additional average handle time is going to attribute to additional FTEs incremental. That's going to go on.
And how is it, not to get into lengthy contract details, but at a high level, if you could, how is the contract with Alorica established such that incremental FTEs are identified and added as needed to meet requirements around responding to customer service inquiries?
So one of the reasons we have the contract, which was, back in the days through a competitive RFP that was conducted by the company. Now, anything which is added additionally to the CSR's scripts, our staffing fluctuates based on the volume and any other additional implementation of the authority orders. Based on that, we work with the vendor to onboard new FTEs and manage through that process. They can add and they can take off employees based on our need.
So is Alorica charging Eversource an incremental increase in these months that you've provided in that filing, I believe, from CAE 22?
Yes.
So there's like invoices associated with those? Thank you. I don't know if this next question is also for you, Mr. Bijan or Mr. Trainer. I think it's on CAE 32 again, to just return quickly to the data dashboard costs. I think that the back and forth earlier was that there was an actual approximately 125,000 incurred in December 2023. I didn't hear whether or not there was clarification about if that's a CLNP apportioned cost or if that was a total vendor contracted cost. Could you help me understand that?
Yeah, I'd have to get back to you on that. I don't recall if that piece of it was just a CLNP or combined between Yankee and CLNP. So we can supplement CA 32.
But in addition to, and thank you for that, in addition to the CLNP and Yankee, can you confirm that Avangrid and its subsidiaries are paying for a portion of this
That's correct.
dashboard as well? Okay, so it should be helpful to understand if the 125 is the full pie or, CLNP's portion of that pie.
Understood.
Chairman, I think that I'd like to request a supplement then to CAE 32.
Thank you.
I think my last question, again, might still be with you, Mr. Trainer. Different topic, but I think relates or was raised at least in your pre-filed testimony from 3-1 that you sponsored along with others. And it's the discussion around the reported hardship uncollectible expense for calendar year 2023. I think we heard this morning, but it's approximately 103 million the company's reporting. Is that correct?
That's correct.
And to clarify or to kind of make sure I'm reading the testimony correctly, that this is a reserve actually for the uncollectibles and not actual incurred expenses for 2023. Is that correct?
That balance does not represent the reserve. That is actually the uncollectible expense within fiscal year 2023.
And how is it calculated then?
So in accordance with PURA order number 5 and PURA docket 150301, the company is required to calculate that balance by tracking the amount of arreared hardship receivables age greater than 180 days.
So
that is
sorry, go ahead, please.
Sorry, that is actually the amount of the reserve is equal to the total amount of hardship age receivables greater than 180 days, and that's in accordance with order number 5 in PURA docket 150301.
Okay, thank you. But that's different than the actual net write-offs. Is that correct?
That's correct. The net write-offs actually represent are related to inactive or disconnected customers. So from a net write-off perspective, a customer is written off when their service is disconnected, whether that's voluntarily or involuntarily. They're issued a final bill, and there's a period of time of non-payment after that point. And that's different from the reserve amount and the uncollectible expense that's included in the SBC.
Thank you. And so the 103 million, and apologies if this doesn't make sense from an accounting perspective, but like, how does that show up on, or how is that tracked by the company on your books? Because it hasn't been written off yet, but it's a reserve, I guess, is what I'm trying to understand the distinctions here.
Yeah, sorry. So I think there's some confusion in terms of the terminology that's being used. So in accordance with PURA order number 5 in docket 150301, I think that final decision was from November of 2015. The company is required to calculate our reserve to equal the total amount of hardship age receivables greater than 180 days. Now, from an accounting perspective, the way that's calculated is each month we will tabulate the total amount of those receivables, and then we will compare that to the reserve, and the actual entry is to increase or decrease that reserve, which remains on our balance sheet, and to actually record that the other side of that entry to uncollectible expense. So it's only the uncollectible expense incurred in the year that is actually included, within the system benefits charge. And that's consistent with our, the other EDC in Connecticut, United Illuminating. We just use different terminology. I believe they use the term active charge-offs, and I believe their order, which I believe was in docket 210104, asks UI to track active charge-offs in the same manner by tracking the total aged hardship receivables greater than 180 days. So I don't know if that helps.
Yeah, that does. Thank you. And so presumably the company is reviewing, even outside the context of this RAM filing, on a month-to-month basis, kind of the changes there. And so presumably there could be a decrease in that uncollectible expense if and when a larger percentage of those customers begin, paying off those unpaid balances.
Correct. So if we saw a decrease in the amount of age receivables greater than 180 days, we would, see a reduction in the reserve, which would therefore translate to a reduction in the SBC expense in that given month. And I think in our exhibits, you can actually see that in one of the months. I think there was a reduction. I think it was the month of May of 2023. There was actually a reduction in the expense in that individual month.
Due to customers submitting
total-
additional payments.
Yeah, it could be a number of different things that
Okay.
flow through that, but ultimately the total arreared balance is greater than 180 days for that individual month came down.
And I think one final question. So if a customer who has a balance greater than 180 days, but then subsequently pays all or partial of that bill, that will still bring down that uncollectible expense, even though it's, past 180 days.
So, yeah, so it would reduce both the reserve and the uncollectible expense, correct?
Which are tracked separately from in the company's accounting, or?
Yeah, those are two separate individual accounts. The reserve is a balance sheet account, and that's just separately tracked within the accounts receivable balance, and the uncollectible expenses and expense presented on the income statement from an accounting perspective.
So just two ways to look at the information?
It's all tied together. I think, as I stated, the order in 150301 in tracking age receivables greater than 180 days, that our reserve balance simply equals that amount of age receivables, and the uncollectible expense is the change. It really fluctuates off of that balance.
Okay. Thank you. That's all I have, Chair.
Thank you, Ms. Cohen. Attorney Keenan.
Hi,
My name's Kate Keenan. I'm a Pura staff attorney. And I'd like to circle back to the company's response to interrogatory CAE 2. I'd like to request a supplement. The company provide an exhibit listing all of the employees, either by name or some other employee identifier, who have involvement in any of these programs, and provide the percentage of their involvement in the specific program, as well as their percentage of involvement in something other than one of these programs listed here. So for example, there's a program manager for the ESS program. 45% of his time will be put towards the ESS program in 2024. There's another program manager for the IES program that also has 45%. 45. So I just want to get an understanding of each of the employees that are involved in all of these programs, their percentage of involvement in each of the programs, as well as their percentage of involvement in something other than these programs.
Is that clear to the witness panel? So we would have to identify, just to be clear, you're looking for the name in addition. So we would file that on a confidential basis,
Sure, or some other employee identifier.
some other identifier. Okay. Is it clear to the panel in terms of what Attorney Keenan is looking for? Do you need clarification? Okay, thank you.
It's to understand the overlap between. Thank you, that's all I have.
Thank you. Okay, we will transition into cross-examination by the Office of Consumer Counsel, please.
Ready? Hey, good morning. My name is Albert Sablowski, and I'm here for Office of Consumer Counsel. During the hearing last week for UI, I believe it was Pura staff and UI's panel that referred to one of its RAM exhibits items as known and measurable projections. Would Eversource agree that to some level at least, that to some level, there's a level of projecting in the known and measurable section of the company's exhibits?
Of Eversource's exhibits or UI's exhibits?
Both.
I would agree that there is some level of forecasting based on discussions with UI, as we had corroborated on some of the discovery that was issued where we would have to compare the RAM components. We did see that. And I would also say that the company includes a known but also very measurable charge within its rate calculation for a cost increase.
Thank you. And does Eversource have any known and measurable line items across its exhibits that are known but not necessarily measurable just yet?
This year, we did expand. There is the NCQF, where we provided the best estimate, best known available information at the time of the January 16th known and measurable filing. In addition to that, we also have, just pulling it up right now, we have the Yep, I have it right here. We have the, within the is it the non-recurring termination payments, which that is a known and measurable, which is certainly a known calculation and likely to occur at that amount. And then I'll turn it over to Mr. Schoenlitz to complete the analysis.
Well, just the way I understood the question was, are there certain items that are, known that they're going to change, but they're not necessarily measurable? And I believe in our known and measurable filing, we included several under the section entitled Other Cost Changes. And those are in exhibits 15 through 26 as part of our known and measurable filing.
Thank you.
But that were not included as a rate change component.
Yes, so
Correct.
that's where I'm sort of going next. Thank you. If we were to focus on the SBC exhibit itself, right, and I think that's exhibit H-SBC from the 3-1 filing, right? I noticed that the 2024 known and measurable adjustment is 0. Is that correct?
That is correct. We did not provide a known and measurable cost estimate to be included in the actual rate increase. However, we did provide known and not necessarily measured cost estimates within our known and measurable filing on January 16th.
But so in that exhibit, has the company provided an actual rate impact of what it would have been should that adjustment be in the known and measurable line item?
We did not provide the actual rate impact. What we did provide was the cost estimates compared to the current 2023 costs that are used as a proxy for 2024, and then the estimates for what we believe to be will likely be the cost for 2024.
Thank you. I believe in the company's last year interim RAM decision, the authority included language which stated, to minimize rate shock and to enhance stability of customer bills, the authority also determined that it would consider any known and measurable, excuse me, net adjustments proposed by the company based on revenues and expenditures expected to occur in the current calendar year. They represent a significant departure from the proxy calendar year data. So based on that, can the company explain what has not included the SBC cost in the known and measurable line item in calculating its rate impact?
I can start with that. I think the largest component that we see, and we did identify in our known and measurable filing, which remember submitted on January 15th, so not a lot of time to identify what was in the test year, what would be in the future, is the low income discount rate program, where there was relatively minimal costs experienced last year, and we expect a large increase this year. So we talked about that. We talked about the drivers of that. We did not propose a known and measurable change because there are a lot of uncertainties around the timing of when that will be implemented. Others on the panel can speak to those uncertainties better than I. But if your question is driving at, do we support moving forward with, or should we have, I think we described in our testimony, structural changes that we believe need to happen with the RAM proceeding in order to avoid significant rate shock or rate whiplash that we've seen each year since COVID. So we support getting to those structural changes. And certainly I think that we should be using forecasted expenditures instead of relying on last year's expenditures to set current year's rates, where last year's expenditures are not a good proxy for current year's rates. And we should be developing processes or adopting processes where we're updating rates more frequently, not less frequently, because that is in the best interest of customers, while balancing having, on an extreme monthly rate changes. I think there are vast improvements that could be made to the process. The concern that we have now is we're sitting in the face of a $784 million increase. We know that if nothing happens with the low-income discount rate program, that on its own will drive a significant rate change next year, all else equal. So while I would support moving towards using forecasts, where we are right now, the increase is significant. And so is it really the appropriate time for us to add on another potentially $160+ million for the low-income discount rate program to reflect that in rates right now? I think that is a difficult position that we're in, but we have an opportunity based on the expected decrease in supply rates on January 1st or July 1st, excuse me, to reset the process, get back to fully collected for these costs. And then I do believe truly believe that we need to make structural changes to the RAM process so that we don't continue to perpetuate this, because it has been essentially an annual occurrence that we've had to mitigate rate changes for customers.
And thank you for that. In company's response to CAE 31, I believe the company stated that the low income discount rate cost will be approximately 170 million this year, right? It seems like a known.
There's, I'm sorry, I think there's some, based on the current level of enrollment today, we project it to be about a $70 million increase.
70, sorry.
If you incorporate the information from the DSS feed, that would result in a $170 million increase. So that's where we get back to, we're not certain where in that range it will be. I think we are very certain that it will be greater than what we have built into the May 1st filing.
So pretty certain that it'll be at least 70, based on.
Correct.
the
Based on
current-
actual enrollments today, if you just annualize that, that was as of January, I believe. If you annualize that, that would be a $70 million annual amount.
Thank you. I just have some follow-up on the CAE 2 process that's been happening today. And just first word, just really clarification. So for program manager of ESS, I see utilization of 9%. And is that primarily due to when this person started or when the program started, or simply to the program not having ramped up yet at that point?
The latter of the question is the program not having ramped up yet.
Okay, so same thing for IES of utilization of 7%, you see?
Same thing there as well.
Okay, thank you. Okay, so I've heard that these are not new positions. Is that correct?
Correct.
Correct. So are these previous employees of Eversource or CLP?
Correct. For the IES and the ES program.
So hypothetically, well, let me start here. When was Eversource's last rate case?
It was in 2017.
And was there a settlement after?
That case resolved itself by a settlement approved by the authority, correct?
Okay, so would salary expense and headcount be a part of that rate case?
So, of course, salary expense and headcount is part of base distribution rates. Just tracking where you're heading with the question, the way that we evaluate and determine the amount that is included here, I think it was a previous question by Ms. Cohen. The amounts here are for those not reflected in base rates. We were talking about in advance of this hearing, whether or not they would be rolled in a future. And I think that would be a question that would need to be reviewed because there are prior PURA decisions or statutory requirements in terms of how these costs, including our FTEs, are collected and reflected in rates. But the costs that we reflect here are those costs or costs associated with positions that aren't previously included in base distribution rates or in other rates.
So hypothetically, and I'm not saying any of these people on any of the people on this list belong to this hypothetical example, right? But let's say you had a staff accountant that moved on to work on these programs, right? And he was working for Eversource at the time of the last rate case, aka his salary expense was included in base rates, right? I understand this is incremental pay, but if, for example, the company never replaced that person with another staff accountant, right? Technically, that would be double recovery because that person's salary is being recovered in base rates and here tracked here also in the RAM, correct?
Sorry to cut you off. I think there's so much more to the hypothetical that we would need to look at, but this issue has been looked at extensively. I have experience in Massachusetts where the same question has come up and we've developed a test that's fairly complicated, but to demonstrate that in that scenario, because there could be, and I don't know the specifics of each individual here, there could be times when the most qualified individual for this incremental position, not included in base rates, is a previously employed Eversource or CLMP individual.
Right.
The fact that that position in that function was in base rates, though, doesn't necessarily mean that it's not incremental, because that work is still being done and still needs to be covered by base distribution rates. So that's resulted in again, a fairly complicated 5-part test in Massachusetts that I am not saying this to claim responsibility because it's complicated, but I think I came up with to show that the amounts when they move over are incremental. So I can't accept just the premise that because an individual was previously employed by the distribution company and now works on these incremental programs, that they're by default not incremental. I don't agree with that, but I know where you're heading, and there are ways to demonstrate and to validate that these costs are truly incremental.
Okay, but would you agree there was maybe some vacancy time? Let's say this person has left to work on these programs, right? And before they were replaced, there has been a period of time, for example, maybe a few months, hiring has been difficult, generally speaking, in the current environment, where there was salary expense and base rates, and there wasn't a position for some time. There was nobody in that position for some time.
I mean, again, I can't agree with the premise of the hypothetical. There's so much that would have to go into it.
Okay, thank you.
Can I just add as well too, in particular for the two programs for the IES and ESS, the employees charging time are energy efficiency employees. They are not in rates at all. They're not in base rates. They're recovered through the CAM.
Sure. Thank you.
Sure.
CAE 38. Where the company stated that BTM resources have not been quantified and are not included in amounts provided by the company, and that wholesale energy and capacity values are not directly measured or quantified. Now, is the company not planning to quantify the impact of these resources at any point?
I apologize. Can you repeat the question?
Sure. So, the company stated that BTM resources have not been quantified and are not included in amounts provided by the company, and that wholesale energy and capacity values are not directly measured or quantified. So my question is whether the company is not planning to quantify the impact these resources have at any point.
I apologize. It's opening.
No, take your time. Thank you.
Okay. I don't believe that was, we do not have plans to quantify that as of right now, as far as I'm aware.
So in the company's next rate case, I shouldn't expect to see any savings or offsets derived from that, correct?
I don't believe so.
Okay, thank you. Next question, has the company quantified the, and I'm being careful here, but the potential impact just based on history of the RAM, of amortizing the RAM under recoveries for some certain time period, just general?
There was a response that we had provided where we were asked to present an amortization extending recovery for 22 months and 36 months, which we do not support because it will harm customers by adding carrying charges. So we did calculate there the impact. What is it? CAE 34. So CAE 34 is the response that we had presented our analysis and the incremental costs. Right about that. We think it's CAE 14.
And has the company modeled the impact of amortizing a specific cost over, again, some time frame? It's really the impact on key rating metrics?
I don't know that we've modeled specific, the impact of recovery on key rating metrics. Where our concern is really from a customer perspective, like I said a moment ago, the issue we're seeing is by amortizing costs, it's not like these are a blip. These are costs that are annually recurring, that have been pushed forward and now is resulting in a nearly $40 a month increase for our residential customers, which is significant. So from a customer impact perspective and just from a use of the company's balance sheet perspective, we don't think it makes sense to continue to push these costs forward. We think it makes sense to modify the RAM proceeding so that we can get to a place of having systematic rate changes for systematic costs if they're incurred on a systematic basis. And as long as that's the case, then there shouldn't be an impact on our credit metrics.
Okay. But would it be possible to obtain an exhibit if available where the company shows an impact of certain length amortization, the cost on its credit ratings?
I think CAE 14 is.
We'll do that. Okay.
That describes all the things that I'm saying and presents the analysis of amortizing, the added costs of doing so, and reasons why we don't feel it's appropriate for our customers.
And commissioners, I'd like to add a legal comment, if I may, in response to the OCC's question. So the question posed to Mr. Horton was, is the company supportive of amortizations beyond the 12-month RAM period? The additional legal argument that we have, which we can make in the brief, would be the primary driver behind the change is the increase for the Millstone and Seabrook PPAs. And as the company can point out in our brief, General Statute 16M E3 entitles the company to recovery on a timely basis. In addition to that, we can point out in the brief that the March 15, 2019 contracts that we have for these projects in section 19(7) subsection B states that if the company does not receive timely recovery of these expenses, we would be allowed to suspend performance under the contracts with Millstone and Seabrook. And so in addition to the reasons Mr. Horton offered in the data response, there are additional legal reasons supporting the company's request for timely recovery of, at a minimum, the Millstone and Seabrook expenses. Thank you for that latitude, Chair, Commissioners.
And just the last thing to add as well, we had in our March 1st filing submitted supplemental testimony by myself, Ms. Peruta, and Mr. Callan, talking about the implications and ramifications of just this very point. We have limitations on the amount of capital that we can access and the amount of debt that we can issue, both short-term and long-term. And when it is taken up by these non-core components, it's detracting our ability to respond to our core obligations. When you have 2/3 of our revenues, 2/3 of a customer's electricity bill associated with supply or these public benefit, public policy programs, and the timing of the recovery of those elements is not granted timely, that naturally has an effect on our ability to run the company and to access the capital we need to keep the lights on safely and reliably. And that's our concern with amortizing these costs, which are annually recurring.
And so over the last few RAM proceedings, if you will, what was the longest term of amortization of any RAM component the company had to do or is ordered to do?
I believe 31 months. We had proposed to extend recovery for, and I believe this was the first filing after the COVID pandemic in 2020 when rates were lowered. And we proposed to extend recovery to try to help customers get through that difficult time. Again, we're at a point now where we're beyond the pandemic, thankfully, and extending recovery and adding costs is not, in our view, beneficial to customers. It's not something that we should be entertaining on a going forward basis. We need to get back to a process that systematically reflects the cost of these programs and rates for customers, and we can deal with exceptions as they arise.
Okay, thank you. And do you remember or know off the top of your head what was the total highest monthly amount of amortizations on a monthly basis?
Are you asking dollar amount?
Dollar amount.
Covered? I don't know.
I don't know. Okay. It's okay. Thank you. Okay. SBC. And this is CAE 8. Now, and the company stated that the total SBC expense are poised to increase substantially, primarily due to low income discount rate. Does the company expect an increase in SBC program components outside of the low income discount rate? Again, I'm asking because the unmeasurables were 0. So LiDAR aside.
Could you repeat the question?
Sure.
Thank you.
Does the company expect an increase in SBC program components outside of the low income discount rate, essentially?
So within the known and measurable filing, we did include, again, known but not forecasting measured within our rate increase, but certainly an exhibit that provided the forecasted expense for 2024. In addition to the LIDAR, we provided the LIDAR costs as well as the below budget worksheet and the RES ESS. And I believe those are the exhibits. So it was exhibits for the SBC, exhibits 23, 24, 25, and 26.
So specifically, what's the outlook for uncollectibles?
So for uncollectibles, it's a, there's a lot of variability in that this year with a lot of changes. With the LIDR, we don't know what the impact of that is going to be as far as customer payments. Additionally, with the ending of the COVID moratorium for our low-income customers, once disconnect notices start going out to those customers in April, the pay rate on those, it's been 4+ years at that point, and we're not sure of the impact that's going to have on our low-income customers. Additionally, there could be additional program cost, like for New Start. Once those disconnect notices do start flowing, more customers will look to those programs to get on a payment plan to avoid a disconnection. So those costs could likely go up this year.
Thank you. OCC 3, this is bill impact question. Attachment 1, where the company provided the bill impact per program in NBFMCC and SBC line items. Can the company just quickly confirm what the average, what the average bill that they used was there? Just so we're for myself comparing it apples to apples, I guess.
Well, based on current average bill, based on 700 kW, it would be the 203.84. 203.84.
Thank you. And I've heard the company talk about the impact of the standard offer in July offset, if you will, to this potential increase. Does the company have an educated guess of what would that be? Or I'm not sure if the procurement is complete. I don't think it is. Whether answer that.
In CAE 13, we were asked to calculate what we thought the rate would be, and we had to file it confidentially. So I don't know if you've been able to see that number. So that number is the expectation of what the rate, and it's on a comparable basis. In other words, we take a look at the existing rate. We tried to give a comparable number as to that offset.
We do have access to that response, so we can take a look at that. Thank you.
Thanks. Okay, I think that concludes my questions.
Yep. Morning, Tom Wheel. I'm a lawyer with the Office of Consumer Counsel. I'm going to start with some follow-up questions from some of the testimony that's already happened today. There was a testimony in response to authority staff regarding a labor increase for NRES and RES in 2024. Just had a question about that. Wait for Ms. Purbeck.
I'm ready.
I was just curious, I know in the 2007-01 docket, the company had to file as compliance, its projected labor costs through 2027, at least for our res. I was curious if this increase aligns with that number that's in that exhibit for 2024. I can tell you that number if it helps.
This is specifically related to RS.
Yes.
Yes, do you have that number?
Yeah, I'm looking at it's a compliance filing from 2007-01. It's in compliance with order number 2 in that decision, and the number for 2024 is $1,013,040.
And could you provide the date of that filing just so the witness has that information?
I can try. It doesn't, I'm not seeing a date on the workbook itself, but I'll try to pull that up.
And I would just offer, if Ms. Purbeck's not able to do the comparison, we're happy to give it as a written supplement if that works for Attorney Wheel.
Yeah, the RS projections were based on much lower participation levels than what actually occurred.
Okay, so do you know apologies, the date of that compliance filing was June 30th, 2021, again in docket
Okay.
2007-01.
Yes.
So do you know what the comparable number to that number would be for 2024?
I do not, but we can take that as a supplement.
Okay. Yeah, I would appreciate it. So I guess, Chairman, the supplement would just be asking for the actual number being sought for labor for our res in this proceeding, calculated in the same way as the compliance filing filed in docket number 2007-01 on June 30th, 2021. It'd be the same, the number to compare would be the number in that compliance filing that's in cell F14.
Thank you, Attorney Wheel. And that was which interrogatory would you like supplemented?
Oh,
Can we put that in CAA 2, Attorney Wheel? Would that be
that works.
appropriate?
Sure. I
Thank you.
did not have an interrogatory, so thank you.
Thank you.
I have some questions about the data dashboard costs. I apologize if if it's going to make people switch out a lot. Ms. Cohen actually covered most of my questions about that, but and I know there was a supplement that was requested. I was just hoping to add to that supplement, possibly relating to there was also testimony this morning that there were implementation costs for both 2023 and 2024 for that dashboard. I was just hoping that supplement can cover and delineate those two. So my understanding of the supplement right now is that it's going to show the allocations as between CLMP, Yankee, and the Avangrid subsidiaries. But I'm just asking if it can also show the 2023 actual implementation costs as well as the 2024 implementation costs.
Yep, we can include that.
Thank you.
Can I just clarify for the record, Mr. Trainer, would that be in the supplement requested for CAE 32?
Correct.
Okay, thank you.
My next question is, there was some testimony this morning about an increased call time related to the low income discount rate. But does the company have a sense of, I think Mr. Trainer, this was your testimony this morning. Do you have a sense of what's driving that increased call time? Is it like customers who are with questions about it because it's a new program, or I mean, I don't want to answer your question for you. Do you have a
Likely.
sense like that?
I'll turn that over to Mr. Bajan.
Sure.
So yes, it is, because the program is new and the information that is being provided, it's in its entirety, basically. So there's a lot of back and forth questions, trying to understand. So that causes the handle time to increase.
Okay. So does the company have experience with other programs, seeing a similar increase for new programs and then a corresponding decrease over time? I'm just trying to get a sense of whether the company expects that call volume to decrease once customers become more familiar with the program.
So the call volume, you know, I don't know if the call volume for asking for that information is going to go down, but to make a comparison, in 2021, our call volume where we were discussing, you know, certain orders related to order number 1, 4, and 14 in the authority's final decision under docket 200704 was based on a certain base volume. But as the years progressed from 21, 22, and 23, the volume has been increasing because there's a certain set of new customers, because after COVID, they came into that bracket where this information is being shared. So I mean, based on this trend, I think this is going to be more informational for customers as we move around. Now, if the case might be different for this specific order or information might be different, that's difficult for me to project right now.
Yeah, thank you. Has the company put any thought into whether there will be a call volume impact from, I'll back up a little. Part of the, when the low income discount rate was designed in 171203 RE11, part of the purpose of the low income discount rate or the perceived value of it was an expected offset to uncollectibles. So I was just curious if the company has put any thought into whether should that reduction in uncollectibles result from the low income discount rate, if there would be any corresponding decrease in call volume just associated from less contact with customers who need to set up payment plans, as Mr. Trainer was referencing with respect to the end of the moratorium.
From an analysis standpoint, you know, that deep, like from a volume perspective, I currently don't have any analysis that we've done on that.
I mean, in theory, you would, we would think that more customers being able to afford their bill would reduce call volume, I would suspect, but that could take a while to kind of catch on.
Okay, thank you.
And just to add to that too is customers' financial situations do not remain stagnant. It changes, and we've seen that over COVID as well. So the customers, I'm picking up an example, in 2021 might be okay making a payment, regular payments, but today might have a financial situation. We might have to pre-enroll, like pre-qualify them for hardship, and that might change. So again, the volume can go up or stay steady, but you know, this has to be seen over a period of time because the financial situation continues to change. And these are orders we have to follow on each and every call to make sure we give that information to the customers.
Okay, thank you. I'm switching gears, again, still doing some follow-up questions. There was some testimony this morning about the low income discount rate capital project that's being depreciated over its useful life within the SBC. I was just curious if other than the ESI, there are other capital costs being recovered through the RAM?
Yes, there's a limited number of programs that have capital costs being recovered. There are a couple in the non-bypassable FMCC, and that originated from, you know, the original orders that started those programs. Additionally, we removed the capital associated with those from the ESI calculation, so there is no double recovery of those projects.
Okay. Do you just have an example of other, I'm just curious, other than the low income discount rate? Well, that's would be in the SBC. What's in the NBFMCC? That's
sure, like the DER portal and the DER map. Those were in there for one of them just completed actually, but those were in there for 5 years at a minimum.
Okay, thank you. And that's because those assets are depreciating over 5 years?
Correct.
Okay, thank you. I have some other questions similar sort of about the ESI. There was some testimony this morning. I think Mr. Capozzi was asking about the distinction, if any, for the way that the company treats the recovery of the depreciation and return on capital expenses for the ESI. My understanding is that the same, I think the testimony, Mr. Schellnitz, you might have said that the average depreciation rate as determined from the base rate case is applied. Is that correct?
Yes, that's correct. Because this is a calculation that's being performed for the ESI. It's not going through all the accounting records of the company.
Sure. So is the weighted average cost of capital applied to the total value of ESI plant then? Is that how the return expenses determined?
Yes.
Okay.
Yes, it is.
And the weighted as to base rate plant, the weighted average cost of capital expenses applied to the total rate base, not the plant, not just the plant only, correct?
That's correct, but yeah, I also just wanted to make clear that, what we apply to to that calculation also includes the accumulated deferred income taxes. So if that wasn't,
Okay.
In the ESI.
in the ESI.
So both reflect accumulated depreciation and accumulated deferred income taxes.
Okay.
And I'm sorry, I think I lost your last question.
Yeah, my question was, as for the, obviously, sort of different process that I'm gonna ask about it, I think some clarifications on in a second, but in a base distribution rate case, the rate that's designed for a given rate year is designed to capture, for the company to recover the depreciation and return costs on the expected levels of plant. But not specifically plant as a component of rate base, correct? I mean, in other words, when
Yeah. So in a rate case, yes, but this was a provision of the settlement that allowed for the recovery of additional plant additions over the term of the settlement. And embedded in that calculation are all the associated calculations that occur with plant. So accumulated depreciation is part of that calculation. Deferred income taxes is part of that calculation. Depreciation expense is part of that calculation. Property taxes are part of that calculation. So those were all cared for in the calculation that was prescribed by the settlement agreement related to plant additions.
And I would just say there was a PURA question that we responded to. I'm sure we can point to it, where we provided information related to just the plant components of rate base, that which was included in our rate year 3 calculation and that which is actually reflected in the ESI today. And we showed and demonstrated that our actual plant-related rate base is in excess of the amount that's reflected through combination of base rates and the ESI.
Thank you. I guess what I'm asking, so like the companies, as of March 2023, the most recent quarterly filing, it looked like the current level of plant that's being reported in that filing is like 7.3 billion. Does that sound accurate?
Can we ask for a citation to the record? I just want to make sure we direct them to the right place you're looking at to help them understand the question. Thank you, Attorney Wheel.
Sure. It's actually not in the record in this case. It's just the company's quarterly compliance filings. And I don't even, I'm asking the question just to understand something, so I don't even need a confirmation that the number is correct. Maybe I'll rephrase to say, if in the most recent filing, the current level of plant was approximately 7 billion and rate base is approximately 5 billion, is that because in general, rate base is less than plant because rate base includes elements that offset the value of plant?
Yes.
Okay. So is there a similar offset being calculated with respect to ESI?
Yes. It's the accumulated deferred income taxes and ADIT associated with ESI that offset the amount that we recover for ESI-related revenue requirement.
Okay. But there aren't if there are any other offsets to rate base other than aided and for instance, and again, not referencing a specific filing, but for instance, a regulatory liability that wouldn't offset ESI?
No, we're calculating the strict incremental revenue requirement of ESI-related investments, which are plant, and we're incorporating those. So to the extent there are other elements that would increase the amount of investment we have and would otherwise be reflected in rate case, for example, storm cost recovery, which is significant, it's not reflected in the ESI mechanism, nor are other potential offsets that could be incorporated in rate base in a future rate case. I'm not sure what there would be that would be significant in that regard, though.
Okay. Thank you. I think I just have a couple more follow-up questions, and I have a bunch of other questions that I walked in the room with this morning. Mr. Zablasky was asking about the potential double recovery issue with regard to FTEs, and Mr. Horton, you were describing a mechanism that exists in Massachusetts that can demonstrate the lack of double recovery there. Has the company made any demonstration like that here in Connecticut?
It previously has not been required, and so we haven't put it forth. Since these programs' inception, and like I said, either through PURA order or statutory requirements, the costs, including our FTE costs, are reflected in the mechanisms. And so we've included them as a necessary component of the cost to support these programs since their inception, and that's what we've done.
Okay. And Mr. Zablasky was also asking, I think one of his questions was whether the company's modeled any impact on credit rating metrics associated with potential amortization of the costs associated with this filing. I have a similar question, but slightly different, which is, has the company been able to isolate any credit rating metrics associated with historical amortizations from prior RAM proceedings?
Not that I'm aware. No.
Okay. Thank you. All right. The rest of my questions are primarily about the kind of two cash flow testimonies. The first, I'm actually going to start with the supplemental testimony that was filed on March 1st. That was Mr. Horton, Ms. Peruta, and Mr. Callan's testimony. So page 8 of that testimony, is everybody ready?
Yes, we're there. I'm there.
Thanks. It discusses the company's needs to finance, it says operating expenses, capital projects, state mandated energy purchases, and storm costs, among other cash uses. And it goes on to highlight that over the past 4 years, the company's had to finance over $1.7 billion as compared to approximately $632 million in the prior 4 years. Just wanted to understand that 1.7 billion, is that the total? That number represent the total amount above and beyond what the company has received via rate revenue in both base distribution rates and RAM revenue that's necessary to continue to cover the costs that I've mentioned?
Just a moment to confer if I could.
Sure.
So the answer would be yes. It's the total financing requirement for the distribution company over the last 4 years, whatever the reason.
Okay. So it represents the total amount of capital that the company had to raise over the past 4 years above revenues received from distribution business?
Yes.
Okay, thank you. And the two timeframes being compared on that same page, the 2016 to 2019 versus 2020 to 23, there's a comparison in average annual spend across those timeframes. The first one being 158 million on average, and the second being 431 million on average. Does the company have the actual annual spends as opposed, I'll back up. My understanding is that those are just the total numbers across those timeframes divided by 3 by the number of years. Is that correct? Is that what the company, that what you mean by average?
The annual average, yeah, so divided by 4.
Right, thank you. Do you have anywhere a breakdown of what, as opposed to an annual average, what the actual annual financing has been?
We can provide it.
Could I ask for that maybe as a supplement to this supplemental testimony?
Okay.
Which is exhibit ES1 supplemental.
Okay.
Thank you. So is it fair to say then, there's the 1.7 billion that was financed between 2020 and 2023, and the 632 million between the prior 4 years. So does that mean that the total that's been financed between 2016 and 2023 was around $2.3 billion? Just adding those two numbers together.
Yes.
Okay. And has the company's, I was looking again at just the financial compliance filings. It looks to me like from September 2016 to September 2023, the overall increase in rate base was $2.122 billion. Is that accurate?
I can't answer with the compliance filing. I'm not sure.
Okay. I'm just trying to get a sense of what out of that 2.3 billion, how much of it was invested in rate base over the same time period? Is that something you could provide as a supplement?
Yeah, I think, yeah, we could provide it in the same, I think, just breaking it down.
Sure.
Okay.
Right, yeah, that would be great. So maybe if that supplement chairman could show not only the yearly financing, but a breakdown of what was invested in rate base per year.
Okay.
Thank you. But following up on a question that Mr. Zablaski and I actually have already asked, just some more questions about credit. The testimony on page 11 notes that a credit downgrade would further limit access to capital resources. And specifically discusses the FFO to debt ratio and the impact on credit rating agencies on that metric. We already talked about whether the company has sort of identified what impacts there have been historically or modeled what it looks like potentially moving forward. My question though is this testimony referencing specifically CL&P's credit rating or Eversource's credit rating or both?
CL&P's.
Okay. And is Eversource's credit rating taken into consideration as a metric by credit ratings agencies when rating CL&P's credit?
So just to that point, the operating company, the credit metrics, and all of the discussion that we're talking about in the testimony and at this hearing are exclusively associated with CL&P. The Eversource Energy at the parent company level is completely separate from the operating subsidiary. Saying that, there are, I believe it's for S&P, there is a tie to the parent company credit rating and the operating company, where if the parent company moves up or down, so too may the operating company. If the operating company has negative credit ramifications either through the metrics, you've asked a number of questions on, specific cash deficiencies and how will those impact the metrics, which is difficult to do. But the credit rating agencies evaluate the operating companies for a number of other reasons that are qualitative, the regulatory environment being the key and biggest contributor as far as the operating company's credit rating. Separate and apart from any FFO to debt metric, the environment is a key consideration. So too here we're talking about recovery of purchase power agreements that our balance sheet is utilized to support for the state mandated programs. The credit rating agencies typically view those as being recovered and reflected on a timely basis. And if they were to systematically be denied recovery on a timely basis, you could ensure that that would have a negative impact on CLMP's individual rating, for sure.
Okay. Was there you mentioned S&P, was there a rating action from S&P recently on March 5th? That you're
I
aware of?
believe that there was, yes.
Okay. Have you reviewed that?
I did, yes.
Okay, and doesn't that, as an example of what you just mentioned, that report actually specifically notes that the negative rating for CLMP reflects the negative outlook on Eversource? Is that accurate?
So I think what that was saying again is for CLMP, the adjustments for the operating companies can be tied. So if they take an action for the parent company, it can be tied, or the operating companies will take a similar action. And that's what happened there. That was actually an improvement because the prior rating, the prior rating had anticipated some events which were now alleviated from the rating agency's mind. So although it was a negative, it was an adjustment that was a positive for both CLMP and Eversource parent company.
Yeah, what were those events?
I'd have to go back and review the report itself. We could do that on a supplement or however you would like us to.
Sure. Maybe if the company could just provide that report as a supplement, again, to the supplemental testimony, which is ES1 supplemental.
Okay, so just adding the March 5th, a copy of the March 5th S&P action.
Yes, thank you. I have some questions about the discussion, and I think it's addressed in both the supplemental and the February testimony.
Attorney Will, I'm sorry to interrupt. Is this a good time to take a lunch break? Just
Yes,
thinking,
I have,
Okay.
yes.
Okay, so let's take our lunch break and we'll reconvene at 12:45 with OCC continuing its cross. Thank you.
Yeah.
I know, between me and Jeff, we're pictures, she look like I'm texting. Yeah, well, the first time like. Keep it up.
Sit up in the chair. Yeah, I just ran it right into my phone. But, I'm stuck on this chair. Oh, there I am. Sideline. That would be. Very simple. Built by a 70 corporation, so one employee, so even if he or she have $100,000, because they put different. Take this. Yeah, well, you move to another place, companies continues to charge, you can go and go. Yeah. Right or wrong, it's a different story. There's more that. Overall, it's, there are employees. What program? Huh? That program is. Okay. It's about their cost of that program. It's about their cost. Right. Well, you see, I can. But they're not distribution. They're not. So so none of them are working, none of their expenses. Related to distribution? Right. Okay. So it's only the programs that you're talking about. So it's this program to this program. And they were always never into distribution rates. Okay. Supporting these programs. And it's just. But isn't it ultimately goes, I mean, the biggest, what I see, the biggest item is the distribution rates, the customer. Yeah, but your distribution rates, it's a whole, that will come up again until. When is this? I'll be, if I have a scholar. Yeah, if you don't mind, I'll listen. Sure. You see, the thing, what I relate there is that working at Sikorsky for 15 years. Okay. So I worked with Blackhawk. Okay. And then they moved me to the 53K, which is the new program. It's a new helicopter. If you type 53K, you get tens of pages of. Yeah, no, I understand. So I worked there. So Sikorsky charged the U.S. Army because I was there. But now I moved to the 53K, which is the it's different. So can't charge the Army because I'm moving to the Navy now. Right. Even though the Army and the Navy are the same umbrella. Program. So this is a collective different ways, different budgets. Exactly. So you have to move everything. Exactly. That's it. So it's the same kind of thing. Yeah. Well, it's the same kind of thing that movement has to happen. It's cost. Right. If that, you know, that's, you know, back down or that ends, then, you know, either they get put somewhere else and their costs show up, or they go away. Right. You know, because that's just the way it. Yeah. That was one of the reasons that when I moved to the Navy program, actually the Navy wanted me to get the whole Navy to understand the budgeting aspect because it was $100 million operation. So the Navy actually paid for me to get my
opportunity, not just Ohm's law and Kirchhoff's law, but also the
no, there's a lot to this, though, like I said, there's the
other
different,
side parameter.
the different filings that fall out as part of this, docket. There's hundreds of pages.
Oh, yeah.
Documentation, because it's all documentation, common documentation. That supports.
Right, yeah. This is very interesting.
Yeah, so I mean, it's not, without, without most people don't get to see this or understand.
No, I actually enjoyed it because it's another part of what I.
Because the other with this whole, almost everyone that they do now, you go on YouTube.
Yep.
They play it on YouTube.
Oh, you can see, okay.
So this has all been recorded.
Yeah.
And-
Oh, I can see.
Right, so it'll, from time, the whole thing is on YouTube.
Yeah.
So for example, the other electric company in Connecticut,
Yeah, you're right. Yep.
Okay, theirs was Monday of last week.
Hmm.
So that was, 3 hours longer, whatever, but the same thing, that whole thing is, on YouTube.
Hmm.
When you, say so, it's a good opportunity for people to go with it, view it after the fact.
Right.
They also have, you can go in live through the Pura website.
Okay.
And so it would be like you were sitting there, but you're sitting at home.
Right,
Looking at the
watching
screen.
it, yeah.
And a lot of people do that too.
Yeah, but it's completely different. Sitting
Oh,
here.
absolutely, it's like going to a baseball game or listen, or, watching it on TV.
Exactly.
Right?
Exactly.
Yeah, it's not the same. Because you really don't get the same.
No, you don't get the
feel
same.
of what's going on.
And the cameras are focused on certain locations. And if somebody speaks and is not really, it's only at the corner of the camera, you can't really see
Right.
the person.
Yeah.
It's, yeah.
Yeah,
Well,
it's not
no,
like
I-
if someone,
yeah.
the dude just set up the.
Yeah, yeah,
show.
it is, it is what it is. Excellent. Is anything that I can give you or I can provide or anything? I really appreciate you inviting me, but if
No,
there is anything that you're looking for me
No.
to do or to say or.
No, that's, well, you're here as a public participant. And you have the right, typically they'll, if you wanted to say something.
Yeah.
You come to a meeting like this, approach one of the staff. For this here, which is Pura, they have that public comments. Okay. And, but they pass with that, they'll, a lot of times start hearing that. So we'll have comments. Could also write in. Okay. It's also an option. Docket.
Right, yeah.
You go on your website and see people have done that. Okay. And people, that's, a lot of people do that. They want, they want to make it available.
Right.
So, that's, yeah. So you staying for the after lunch?
No, I think I'm gonna, unless you think that I should stay, I don't know.
I don't know where this is. It's hard to do it right now.
Yeah.
I don't know what's gonna happen.
I wasn't planning, I was planning to sit for a couple hours, listen, see what it is.
Yeah, we do it later.
Yes, and not just that, but if there is, well, I'll be interested if there is a meeting like this that it's more on the technical term that you are aware of, I would be delighted to come and sit down and listen. And,
yeah, well,
you see, I don't, I don't feel, we had a very good discussion, but I don't feel that I either can contribute or even make comments because
we'll see a lot of
it's
people. This is a contribution, they think. Too high. Okay, look, you gotta see that, you know what I mean, so that doesn't, that's
No, but
not.
I mean, I can, you see, I can make a very specific comment
Yeah.
that I can relate to my,
Yeah.
to my experience.
So I think more
but-
years before the main distribution.
Right,
You know,
yeah.
Cause these are all track funds. To that, you know, in their own, they're totally outside of.
But the,
you know, the tradition.
but the big question is, 50,000 feet is that, okay, so we have all these costs, all these expenses, people working here and there, but ultimately, all of those expenses are related to moving the electricity to the customer.
Not these, not most of these here, most of these are for programs.
Okay,
So like any of the.
but isn't, I mean,
but
the
that's-
com-
So moving elections is kind of distribution. Right?
Yeah.
Which is a great case if you talk about.
Right.
And the other thing is transmission.
Right.
The transmission costs.
but the program, when you say program, let's say the low income
We
people
talked
program.
about, right,
Okay,
right.
so, but that program, ultimately, what does it do? It address the cost of giving electricity to somebody with low income, isn't it? I'm asking you what's stated.
Well, what's. Part of that. Cost implement. Nothing. to do with-
Isn't what I'm paying as a customer that I'm very fortunate that I can pay whatever needs to be paid.
Yeah.
But isn't, I'm just gonna use purposely a number, isn't, let's say, 10 cents of what I'm paying, or $1 of what I'm paying, ultimately go to pay for those people that don't have the money.
Eventually,
Right.
it does, well, yeah.
Through the circle, I mean, it's a
Absolutely.
big circle. Yeah. And this is what I'm saying, that those programs are designed and implemented so that this $1 that I pay ultimately goes to somebody that cannot pay. it.
Yeah.
And I'm,
That's how
I'm,
low
with
income
you.
works.
And I'm one of
So,
those, yeah,
the socialized cost.
exactly, yes.
And, you know, everybody takes support it.
Yeah. And I'm for that.
So there's low income, there's a lot of other things that come through the legislation to support, you know, clean environment.
Yep.
Resources, all that, right? It all costs money. So, you know, every time one of those new programs come in, you know, okay, so we want you to, you know, do this and spend this amount of money and help offset that. It all costs money.
I would like to see, and I don't know if it's something that you can connect me with, but one of the things that this is part of my experience and expertise is solar panels. You know, and although Connecticut is not the size of Texas, there is plenty of space in Connecticut that is, we call it dead space. But you can put a bunch of solar panels and point them down south, and let me tell you, you can make a lot of electricity, and the sun is paying for that.
It's a lot. Well, yes and no, because, you know, the developer will come in and build projects, you know, and, you know, it just does produce energy. But the problem is it's not like a traditional generation where you flip a switch and it runs.
Of course, yeah, of course.
It's only gonna run.
You see, I'm
And then-
starting with
and
a
then-
solar panel, but realize that. You take a solar panel, and then you take a room this size, fill it up with batteries, lithium-ion or whatever it is. Solar panels are filling up batteries, and when there is a higher demand.
That's what they're doing.
Yeah.
They're already doing it. The programs.
Okay,
There's a lot.
it's great, do they have enough programs to do that?
Well,
What is
costs
the,
money.
Yes.
cost money.
And
So
and the
make
question
them-
is, how many megawatt, how many gigawatts versus,
But again, the problem is that costs more to do that.
no question about it, it's an upfront cost, but when you do this, for the next 20 to 30 years on the average, doesn't cost you anything. It's still like, it gives you electricity. The maintenance is very low.
Yeah, but then they're getting paid. They get paid at special rates.
Yeah.
That are above costs.
No, no,
You know
I
what
got
mean?
this, I got this.
You know what I mean?
Gene.
So,
No, no,
yeah,
no,
so,
I
yeah,
got
it all works its way through.
So the question is there is anything, this is where I believe you see.
Well,
this
you see it
point in
more
my
and
life,
more
I
of it.
believe that they can contribute, and I'm
No.
willing to work with the company, and I'm not looking for any money. I
No.
just wanna,
But a lot of that, like you said, that all gets done through programs. You know, you know, there's a lot of developers out there. There's a lot of legislators that are pushing it. The whole environmental committee.
yeah,
You know, that's another whole aspect of this is that every year, our state senators, you know, push through different programs.
Almost done. What? What's kept going on? Yeah, yeah. Quarter off, that's free. That car was tough, especially for those guys. Wow, right? I always bring my lunch.
Yeah. Yeah. I'm still here, you're still here. Yeah. 40 for me.
Yeah.
Okay.
That's all I did. I'm gonna do probably like Georgia, they're driving.
Huh? Where you said?
Here, yeah. We just switched.
Okay.
Commissioners, I apologize for us running late. Thank you for your latitude on that. Yes, we are.
Okay, very good. Attorney Wheel, we can resume cross-examination with the OCC, please.
Thank you. My next couple of questions are about the issue of carrying costs. I think it was addressed in both the supplemental and the February testimony. The perspective that the weighted average cost of capital is the appropriate carrying cost for recoveries that exceed a year, but that the prime rate is the company's position that the prime rate is appropriate for shorter recovery periods?
I can speak to that. Yes, I mean, the prime rate is a proxy. It's not tied to the company's costs or customers' costs of capital, whereas the weighted average cost of capital most certainly is. And so it's not uncommon for the prime rate to be utilized for short-term recoveries. We talked about this in the proceeding that was on the heels of the July 1st, 2020 rate change, which resulted in the current RAM process. In the jurisdictions that we operate, prime is a proxy for short-term carrying costs, generally not offset by accumulated deferred income taxes, because accumulated deferred income taxes is a rate-based animal. And we talked about that a little bit earlier. So we apply the prime rate for short-term recoveries, but certainly for longer-term recoveries, the carrying costs that we incur is our weighted cost of capital. And so anytime recovery is extended, if we're trying to result in a principled approach that's based on our costs, the weighted average cost of capital would be the rate that's applied.
Okay, thank you. I'm aware, of course, and I think this is referenced in the testimony, that this issue is presently on appeal, I think in more than one case. So I'm not going to ask questions about those appeals specifically, but my general question is, has the company raised that specific perspective before here in Connecticut that the prime rate is appropriate for shorter term recovery?
I recall in that proceeding that I referenced, I gave testimony, I believe in writing and on the stand, and said what I just said, which is that if we're talking about reconciling balances that are for a short-term nature, it's appropriate to apply something other than our weighted cost of capital. Generally, the WACC, or the weighted cost of capital, is for our longer-term rate-based items, generally, longer term in nature. So you apply a long-term debt and equity, which is supporting rate base. And so, yes, for short-term reconciliations, we would see the prime rate as being appropriate.
Okay, thank you. And so the weighted average cost of capital would be the authorized WACC as most recently determined, I think in rate year one in docket 171046, is that where
That's right.
okay. And then it's was that, can you remind me, was there a different weighted average cost of capital for the 3 rate years in that decision, or was it the same across all the 3 rate years?
It was the same ROE and the same capital structure, I believe. There perhaps was differing costs of debt, unless Mr. Shelmans knows.
I think that's correct, what you just said.
Okay. So is that, what is the weighted average cost of capital net of ADIT right now?
So we apply the weighted cost of capital to rate base. Rate base is incorporated or is inclusive of ADIT. So we don't have a weighted cost of capital net of ADIT. I think you know the weighted cost of capital grossed up for taxes. 8.98%.
Okay. Thank you. And the prime rate, I think that just trying to get a sense of what numbers we're talking about or what kind of references. My understanding is the prime rate that Pura's directed in the past would be the prime rate established at the time of filing. Is that the company's understanding?
That's correct.
So would that be the prime rate from this past February?
Correct.
Okay. And was that 8.5%?
That's right.
Okay.
But just to be clear on this point, and I heard questions, we watched the UI hearings a week ago. There's a lot of discussion on the prime rate. So 2 points that I want to make. One is, as I said, anytime we're extending costs beyond a year, our costs are the weighted cost of capital. So our testimony is leading for a principled approach to establishing how we will set the cost of that capital, as opposed to, yes, the prime rate is in the same proximity at the weighted average cost of capital. The difference in terms of recovery for the company is de minimis. The principle is important, however. The fact that the prime rate is approaching parity with the WACC shouldn't matter. Just like when Pura adopted the prime rate, we argued for what I was reading those questions from your office to be asking of UI, which is that you shouldn't set it at a fixed amount. If you're going to use prime, you should use the actual prime rate that's in place on a monthly basis. So really our whole testimony is that we should be establishing a process that's predictable, that is based on principled analysis of what the underlying cost should be. And if you're extending costs beyond a year and we are amortizing that cost using our balance sheet and our equity and debt, we should be applying the weighted average cost of capital.
Oh, thanks. Does the company have a position on the idea of applying the prime rate on a monthly basis, like tying the prime rate to the actual monthly prime rate as opposed to the fixed prime rate that existed at the time of filing?
We do, and we submitted that idea 2 times in written comments and then written exceptions to Pura back in docket 220908. And neither time were we listened to. Our position is what I just said, that we think that the prime rate, if used as a proxy for short-term costs of capital for customers or for the company, should be based on the actual prime rate in effect. It doesn't make any sense to me to have it fixed at a point in time if it is reflecting that short-term cost of capital. It also doesn't make any sense to me to apply the accumulated deferred income taxes on the balance for a short-term element like that. But in any event, so yes, our posture is if we're trying to get to the underlying cost and that underlying cost is reflecting a short-term difference that needs to be reconciled and we're going to use the prime rate to do it, I see no other reason than to use the short-term or the actual prime rate. But for the fact that in this instance, that, we argued for that twice when Pura adopted this approach. We said, hey, if this is what you're going to do, you should be basing it on the actual prime rate. At the time, prime rates were increasing. So if we had applied the actual prime rate at that point in time, it would have resulted in a slightly higher carrying charge applied from a customer perspective. Now that prime rate is decreasing, if we're to move to that approach now, it would seem to me that we're just searching for any way to find a process that will, break in the customer's favor, as opposed to having a principled basis in setting rates that we can count on and that we know the rules that would apply. If it's intended to be done in a certain way for whatever rationale, then it should be applying through time, regardless of which way the numbers go, which is why we think that it's appropriate to apply the WACC if you're extending cost recovery beyond a year, even if the prime rate were higher than our WACC. I would be arguing that that is the approach. It would result in less collections from us, but we don't care. We're not arguing over the dollars, we're arguing over the principle because that's what should be applied.
Thank you. I think you've already addressed this just now and maybe in response to my previous question, but I'm still not completely clear. I mean, I hear that the response is that it makes sense for the short term, from the company's perspective, to apply something other than the WACC, again, for recoveries shorter than a year. And I see in the testimony, the company's assertion that the WACC, that the prime rate is inappropriate because that's the interest rate that commercial banks charge to credit-worthy customers. The company doesn't have the same access to funds. I understand that that's the argument in support of the WACC being more appropriate, but I'm still not clear on why that rationale doesn't apply to shorter term recoveries. I mean, if the prime rate's inappropriate for longer term recoveries, why is it not also inappropriate for shorter term recoveries?
Well, if your question is, would we be amenable to applying the weighted average cost of capital, whether it's for a year or less or longer? Yes, we would. And that's how it had been done prior to that 2020 RAM guidance decision. We applied the weighted cost of capital to over and under recoveries, even if they were less than a year. I certainly find that to be a defensible and principle-based approach to setting cost-based rates for these reconciling mechanisms. And in fact, when you looked at that point in time, we showed that over time, we were in a net over-recovered position, had use of customer capital for these programs against which we applied the weighted cost of capital. Now, during COVID, things got upside down, resulting in a significant under-recovery for the company, and the process was then changed. So my testimony is simply that from a pure rate-making wonk perspective, which I am, if you look at the reconciling rates, for example, that we have in Massachusetts and New Hampshire, we apply prime rate to reflect the short-term nature of those reconciling mechanisms. In all jurisdictions, these mechanisms are intended to recover the costs that are being incurred in that period. So the reconciling nature of those mechanisms says that if things get out of whack one way or another, carrying charges should apply, whether we owe customers something or they owe us something for the use of our capital in the interim. So I don't have an objection to applying the prime rate as a proxy because there's a lot of complexity determining something different. If we were to rely on our short-term debt rate, that would require a process for all of us to agree on what that rate should be. If it's a customer, cost because for whatever reason we are over collected, so we have the use of customer capital, what would be the right rate to apply there? So there's a lot of debate that you can have. Ultimately, prime rate has historically landed somewhere between 0 and the weighted average cost of capital and has represented, at least in my mind and in my expertise, a proxy for what the cost of that capital is in either direction. But anytime you get beyond a year, and especially here we're talking about amortizing costs, extending recovery of actual costs that are incurred in a period, using our balance sheet to do that, that's our WACC. That is, there is no dispute in my mind over that.
Thank you. I think I understand that. So I think the idea is that the notion is that, or a shorter recovery period, shorter than a year, the cost of capital is intuitively something less than the weighted average cost of capital because it would be shorter term, but the actual cost of capital would be less than the longer term, than the cost of equity, the entire components built into the weighted average cost of capital. So the prime rate's, as you said, I think a proxy to approximate that effect. Is that accurate?
Correct.
Okay, thank you. I want to talk a little bit about pages 9 through 10 of the revenue requirements and cash flow testimony, which is the February 15th testimony. Generally frame, I think the company kind of frames two issues. The testimony makes the statement, the company's annual adjustments are not aligned effectively and produce exaggerated year-over-year variability in rates. And my understanding is that the company kind of points to two drivers for that variability. So first, the company talks about what the testimony refers to as a natural hedge created by Millstone and Seabrook contracts and their interaction with the standard service procurements. That natural hedge being broken because of the time differential between the recovery of the GSC and the MBF-MCC. Is that correct?
Correct.
Okay. So, and it sounds, my understanding is the company is proposing that a way to resolve the break of that natural hedge would be to just shift the timing to recovery of the NBFM, or at least some components of the MBF-MCC to align with the GSC?
There are several aspects of our proposal, and that's one of them. But when we look at this, constant annual experience that we've had, we see the main driver being the MBF-MCC, and the main driver of the MBF-MCC being those contracts, the Millstone and the Seabrook contract, which are tied to the market prices for energy. So the concern that we have is when we're relying on last year's actuals and setting current year's rates, we know that is not a good proxy for current year's rates. So we think that we should apply some different intelligence to how we set current year's rates, and that would apply for all components of the RAM. Whether we're relying on forecasts for everything or whatever. Our position is we should be relying on forecasts and updating rates when the current year's costs get out of alignment. So the main driver being the MBF-MCC and the Millstone, the MBF-MCC being driven by the Millstone and Seabrook contracts, which are tied directly to the market prices for energy. So we see their value, we see there being value in aligning those with the rate changes for the market prices for energy, both from a customer understanding perspective, but also there could be some rate mitigating impacts associated with that. The issue we have is nothing that we do and decide in this room, we're never going to be able to, the company can't, the OCC can't, PURA can't time the market or outrun the market or predict with accuracy what the market prices are going to be. So no matter what we use as the basis for setting rates, we also think that we need to establish some mechanism to update them in more real time. So that way we're reflecting the costs. If things get out of whack, we don't want to have monthly or more frequent rate changes, but if things get out of whack, it makes sense to us to bring them back into alignment so that we're reconciling that variance in more real time as opposed to allowing costs to pile up into the future and then be faced with what we're faced with here, which is a significant under recovery from last year that would be severely mitigated had we increased rates to a lesser extent last year. And so we see there being value in taking a holistic view on the RAM process to try to reestablish a way to avoid the rate shock that originally had us looking at rate changes. I mean, just to put into context, if we go back to July of 2020, the overall increase in rates that customers experienced, which of course we were in a different time, it was also at a time when summer usage had increased and was a very hot summer. Customers were home due to COVID, but the average residential bill impact for customers was a little north of $5 a month. And we've revamped the process to try to avoid that by not relying on forecasts. And here we are talking about a $40 a month increase in our rates. So we think it's time that we look at other process changes that would try to avoid these significant costs from piling up.
Thank you. And I do have questions about, I think your response just now sort of addressed kind of both of the issues that the testimony discusses, which as I see it are first, the kind of timing, as you just discussed, the timing alignment of the market supply prices with some components of the MBF-MCC, and then secondarily, there's the issue of forecasting using last year's actuals. Is that a fair way to frame the kind of two driving?
Those are the biggest things. We did have, I think, a half a dozen or so recommendations. Those are the biggest drivers that we see. But again, we think it makes sense to rely on forecasts instead of actuals. We've gotten a lot of questions on known and measurable. I know that I've talked on this stand numerous times that has a particular meaning to us. That seems like there's some confusion, certainly on our end. And I've said this, I think in that 2021 hearing, we don't know. We're doing what we think you want us to do. We're not relying on forecasts. Known and measurable has a particular meaning. And then we get a lot of questions on, well, why didn't you include this, that, or the other forecast? We think it makes sense to use forecasts. And then if that forecast becomes proven to be out of alignment, that we would try to get them back into alignment because the goal of this process should be to have systematic costs reflected in a systematic way. And I'm sorry, I'm just trying to find where we summarized our half a dozen or so recommendations. Just so that I can point to it for the record.
I think it might have been beginning on page 38 of the February testimony. Maybe that's a little early.
Yeah, I think it's in that range, and I apologize. I thought we had it bulleted out concisely, but I'm seeing page 34 of Exhibit ES1 from February 15th as listing out those, the main main elements. I'm sorry, listing out the main proposals that we had made on the RAM process.
Yeah, yep, page 34 has, there begins the list of bullet points. I had a question about page 33, actually, which shows figure 2 shows a chart where the company conducted a comparison, a historical comparison. I think with essentially what the revenue requirements would have looked like as to the Millstone and Seabrook PPAs. If the adjustments had been aligned with the GSC, is that what that chart's showing?
So it's showing conceptually two things, but we did make simplifying assumptions here. It's showing had the rate changes been, no, it's not showing any offset to aligning when rate changes were to occur. It's simply showing if rates were recovered in the period that they were incurred.
Okay.
So we're showing in the lighter colored bar under the PURA method of relying on last year's actuals and setting current year's rates, that has a compounding impact on customer rates because last year is not a good predictor of current year's costs. And so you're building in an inherent over under recovery, which is step one in the following year. And then you're setting rates at last year's level. So you're seeing that compound by the lighter colored bar being greater in every year than the darker colored bar. The darker colored bar is simply showing, and I'm looking at it in black and white, which is why dark but anyways.
Blue and green.
Blue and
The
green.
larger ones being green. Yep.
Is showing if you were to have rates reflect costs in the period, what would those rates have been or total revenues have been?
Thank you. So a couple of questions about that. First, has the company done a similar historic analysis to determine, to try to measure like if there'd be a mitigating rate shock impact to only aligning the timing? Again, only the proposal of moving to start with the Millstone and Seabrook recovery to the July point to align with the GSC. Has the company sort of measured?
Yeah, and that won't work on its own because the periods that you're talking about are then so vastly different. So when we set rates for the supply prices, we're setting rates for that current period. And Mr. Rogan could speak to this if I get over my skis, but we're setting rates for the current period. So January to July, July to December, and it's based on procurements which have occurred over time for the 12 months prior. So right out of the gate, that may not be tied directly and exactly to the underlying market prices for energy, which fluctuate daily. So that's one issue. The second is, like I said, even if we were to align or just align the Millstone and the Seabrook reconciliation with January 1 and July 1st, if we're doing that based on last year's actuals and then reconciling them, I don't know what the timing would be, but a year later or 16 months later or 18 months later, whatever it would be, it's just too far out of whack. And we've seen the LMPs vary significantly from day to day. So we know we can't, and like I said, we can't, and we're not trying to beat the market or predict the market or outrun the market. We're trying to get to a rate-making process that reflects that we can't beat the market or outrun the market, that no matter what we put in rates has a likelihood of getting out of whack. So really to help customers, we should be establishing a process to get them in alignment sooner. But I don't think you can just do one and not the other. You need to adjust the timing and adjust the basis for which we're setting rates.
Thank you. I guess what I'm ultimately wondering, and I guess I think what I'm ultimately wondering is whether the company could supplement this testimony to show, I guess with regard to the recommended changes, that you referenced, which are bulleted beginning on page 34. If the company could show hypothetically, if those changes had been implemented dating back to 2019, what the effect would have been as compared to the actual rate effects of those years. In a similar way to what's shown on figure 2 of page 33, but expanded to cover all of the company's proposals. Because again, as you just discussed, this figure is isolating only Millstone and Seabrook for the comparison of actual forecast versus using actuals versus forecast, correct?
I think that's going to be very hard for us to do and certainly not in a 2-day turnaround. But I think it's a worthwhile exercise. The reason it will be very difficult for us to do is we don't know what the forecast for all of these things would have been. It's almost like when we're asked today, well, what would your forecast be of X, Y, or Z in this rate component? Well, we don't know. We didn't forecast all of X, Y, or Z because that's not what we're supposed to be doing. So for us to go back and recast what all the forecasts would have been would be very difficult. I think, though, we did try to isolate, and we could maybe work on this with you and figure out a timing for getting it into the record. We tried to answer that exact question. And I'll just say initially that was my thought as well. How can we show what it would have been as compared to what actually happened? But what it showed us is even if we relied on the forecast just for the Millstone and the Seabrook, because again, those are the largest drivers, those forecasts become still very quickly. So it is not a silver bullet to say we just need to rely on forecasts. It's not going to solve the problem. No matter what we use for the basis to set rates in the current year, it's going to be wrong. And if we don't have a process to update it when it gets so far out of whack, we're going to continue to be in this constant state of rate whiplash.
Okay. Maybe I'll ask the chairman, maybe it'd be appropriate for us to issue discovery to try to develop this to discuss in phase 2 of this proceeding. Would that make sense to the authority?
Well, phase 2 of the proceeding is focused specifically on the prudency of expenditures. So it sounds to me like you're asking to revise the scope of the proceeding, which I'm not going to entertain from the bench.
Understood.
So,
Thank you. So given that, I wonder if in the timeline that the company has for a supplement, could the company show at the least the historical, what we have here, as you've just said, Mr. Horton, is sort of a part of a demonstration that's only a portion of what the company is proposing to be adjusted, in that the relying on forecasts as opposed to known and measurable. This demonstrates the difference that would show, but this doesn't demonstrate any kind of timing alignment, whether alignment with the GSC or whatever the company has in mind for a more regular recovery model. So I guess what I'm asking is it possible for the company to supplement this testimony in some way to show more historical analysis for whatever RAM components it can, to demonstrate what ultimate rate impact would have resulted from using the company's recommendations?
Yeah, I hear you. I think we can certainly do our best and then describe what assumptions we've made, and what limitations we have given the time constraints. But, as we've said, we know this is complicated. We're not suggesting that we have all the solutions, and I know this isn't a silver bullet. So we're willing and open and trying to work with other stakeholders on, getting good ideas into the record that can be considered. We won't be able to do that in 2 days. But we can certainly try to come up with something that meets the spirit of what you're asking us to do for sure.
Okay.
Within 2 days.
So, Chairman, maybe that could just be a supplement to ES1, Exhibit ES1, demonstrating historical impacts of the recommended process changes.
Okay. Sorry, I'm just trying to add up. I know the authority is responsible for some of these supplement requests.
Chairman, could I inquire on timing? And that is the assumption in the question from Attorney Wheel was it's due within 2 days. And my question for the chair would be, is there any latitude to allow the deadline to be more than 2 days? And we understand an interim decision will be submitted on March 28th. And I just wanted to explore if for this particular one, which sounds very large, would we have an ability to have an additional day or two beyond that, if that'd be acceptable to the chairman?
We can, thank you, Attorney Pace. We can certainly take this up. I think you're sensing my concern, which is, we don't really have any latitude with timing because we have to draft this decision. And we're already up to, gosh, like 8 supplements. And I just want to recognize that this is not exactly what the intent of the supplement process is. So I'm getting a little concerned about how much evidence we're suggesting is going to come into the record after a hearing. Can we, I mean, I'll note the supplement for now and we'll just take this up as the timing and the collective supplement requests and administrative matters before we go. So I'll just note the supplement request as it stands as to exhibit ES1 historical capturing historical estimates of the company's recommendations. And we'll revisit this and timing during administrative matters before we adjourn.
Thank you, Chairman.
Mhm.
And that was my last question. So I'm going to turn the microphone over to Consumer Counsel Claire Coleman.
Thank you. Good afternoon, commissioners and the Eversource panel. My colleagues have covered the bases. I just have 2, what I think, I guess, are follow-up questions. The first is with respect to the discussions around the LIDR and the anticipated costs around the DSS data match. Thanks, Dan. So correct me if I'm wrong, but I don't think the exhibits 15 through 26 that Ms. Peruta referenced include a specific cost estimate if the customer numbers were to include those that were captured through the DSS data match, correct?
That's correct. The exhibit was updated to reflect the January 2024 actuals, but not all the way through the DSS data mapping.
Okay, great. And I believe Ms. McDonald asked earlier for a supplement through March 2024. Is that my memory's correct there? Okay, so Chair, I apologize. I know you're trying to rein in supplements here, but I think if we could just amend the supplement to CAE 2022 to include a breakdown of the estimated monthly costs for the LIDR separated by tiers if the DSS data match numbers were applied, just so we have that in the record. That would be helpful.
I'm sorry, Consumer Counsel, which I don't have one for CAE 22 or is
It was either 22 or 24, maybe, then
24?
it was 24.
Okay. And I'm sorry, you want it, can you restate that, please?
Sure. So to provide the estimated monthly cost for the LIDR separated by tiers like CAE 24 already does for the current actuals, but for if the current tiers were applied, if the data match was applied to the current tier levels.
Can I just ask Mr. Trainer, do you understand what's being requested and can you provide it?
Yes, like a 1-month example or a 12-month?
I think monthly is okay. Thanks. Thank you. Okay, the other follow-up question I had was with respect to the discussions around the company's phase-in proposal to start with a lower increase May 1st and then a bigger increase in July 1st. There was some discussion about the anticipated impact of standard service rates decreasing and that being the motivating driver behind the proposal and the anticipated savings. But one thing I wanted to think through with everyone is the impact of usage. I know that, usage always goes up in the summer due to air conditioning, other cooling needs, and wondered if you had factored usage into your analysis that ultimately a phase-in would be in the best interest of customers.
Yes. I'll just point you to a spot on the record.
Oh, great. Thanks.
You look at our attachment, CAE 9, attachment 1, page 15 of 17. On that page, we present two graphs. The top graph is showing what the total bill impact would be for a typical customer using 700 kilowatt hours, so not taking into account usage. And you can see, I think it's blue, the darker color is increased on May 1st. So that's showing all the costs going in on May 1st, $38 a month increase in effect for May and June, and then a decrease when standard service rates are anticipated to decrease on July 1st. So that's not taking into account usage, whereas the bottom chart is showing the impacts of usage. And there is a delta, but it's relatively small in comparison. And it's showing that when you do take into account the monthly variability in customer usage, under the phased-in approach, customers are naturally better off for the months of May and June when we would have a lower rate in effect than in the absence of phasing in. And then when the rates increase for July 1st to reflect the remainder of the increase, which is being offset by the reduction in standard service, you can see it is slightly higher in a total basis reflecting usage, but that's not materially so. And so our recommendation is to align the two, so that way from a overall customer rate change perspective or bill impact perspective on July 1st, there'll be essentially no change in the rates that are underlying their usage.
Thank you. I appreciate that. Relatedly, I guess this analysis is focused on standard service customers, and I'm trying to think through the impact to those who are on third-party supplier contracts. What's the current percentage of Eversource customers on third-party supplier versus standard service? Anyone know?
I believe it's about 72% of residential customers. 30% commercial are on standard service and 70% of residential customers are standard service.
Okay, so for those 30% on commercial supplier, what would the impact be to them?
They would see well, the two things, if you're not taking standard service, then you would see the full increase, whether it be on May 1st or phased in. So that is a concern. However, the majority of our customers would see no change. And also for those customers seeing an increase that are not on standard service, at least in the phased in approach, it would be phasing in that approach. So they would see a step change on May 1st, followed by an increase on July 1st, a smaller increase than would otherwise occur on May 1st.
Okay, just to play that back, so you're proposing that the third-party supplier customers would see no change in the May 1st?
No.
Okay.
Oh, I'm sorry. So there is no denying the fact that rates are going to increase for these costs. That is true. So we see there being a lot of value, however, in aligning the rate change, at least for those customers taking standard service. All I was saying was for those customers who aren't taking standard service from us, for which their supply rates are going to change or not, depending on whatever the supply rate is that they're taking, we're still phasing in the increase for those customers.
Right.
Now, they will see an increase on July 1st for the public benefits portion of their bill, reflecting the increase under a phased-in approach. All I'm saying is they will see that on May 1st or in steps on May 1st or July 1st. That's all I was pointing out.
Great, thank you very much. That's all for me, and I think all from our team.
Great, thank you. Attorney Luigi?
No questions. Thank you.
Thank you. Commissioner Karen?
Ms. Horton, can I go back to your discussion with Attorney Wheel? And part of the discussion, you seem to be, it occurred to me that there may be a way to develop, would there be a way to develop a trigger? We could develop a trigger, again, to reduce that curve, spike in the whiplash?
Yeah, so I totally agree. We put that into our testimony as a concept to explore. In Massachusetts, we have what's called the cost of gas adjustment clause. It's similar to the PGA here, but the rate making is a little bit different. What we do is we set rates for the peak and the off-peak period based on forecasts for the underlying commodity, based on NYMEX futures. And then each month, we and all of the other gas companies undertake a review to say, okay, over the peak period, we're supposed to recover $100 million of expenses. But based on the actual prices that have occurred and based on updating forecasts, let's say that we're projecting to incur $110 million of expenses or $110 of expenses. Rates are only going to collect 100. We're expecting to incur 110. There's a 5% trigger that has us refile and update that rate in the interim. And that's the sole purpose, is to try to ensure that we're not building up these large deferrals that sit there and then have to reflect or be reflected in the following year's rate. So we put that out as a concept that we think would make sense here.
Commissioner, if I could just add to Mr. Horton's point in responding to your question, at least for the FMCC rate, that concept already has existing authority from this commission. What I mean by that is the tariff sheet that the authority approved for the FMCC has language that says immediate adjustment to the FMCC charges may be made in the event of a material change to these rates. That goes back to a decision in 2004 and 040319 where you recognize that there may be these types of material changes. And Mr. Horton is now putting a percentage on that to help us have more precision to understand when that might happen.
Thank you. And so what I'm essentially getting from the discussion that you and the OCC had is that we're looking for more potentially using more forecasts more often in an effort to create more rate stability on whether it's May 1st, October, July 1, January 1, just reducing the spikes either way, either going up or coming down, and people just saying, not knowing what to expect. In other words, just relatively stable rates.
That's right. And, if we go back to what got us here, I know that at the time, there was a concern, well, the forecast is the problem because in 2020, the rates that were set on January 1st, of course, didn't anticipate COVID and the impacts it would have on market prices for energy. So that caused a sizable under recovery. And I think with very good intention, we've adjusted the process to try to avoid that. But our experience has been, and the concern is that with these types of costs, there's no hiding from them. The forecast or the amount that customers will ultimately pay, the forecast is irrelevant. If the forecast is wrong, it becomes a timing issue of when the customers need to pay. And so I think we're better off having a process that says that acknowledges that rates should be reflecting current period costs. And then when they're not, we try to adjust that while also balancing financial impacts on the company and customer rate experience so that we're not looking for like a real-time rate or a monthly rate that will produce on its own wild swings. But we do think there's value in having a trap door or something like you're saying, a threshold, where when things get out of whack, we get them back in alignment more frequently.
Okay.
Exactly.
Okay. Thank you, Madam Chairman.
Very quick question. Of course, I get lots of questions about this potential increase, and I'm wondering what the company's doing to make the customers aware, educate the customers. I'm in church trying to have a peaceful mass, and people are asking about their electric rates. So what are you doing to educate and prepare them for whatever we decide to do with this?
Yes, I think others on the panel can speak to customer communications. I can say from my own part, I'm, beating the pavement. I'm doing a radio interview, which was awkward and new for me. So we're trying as best we can to get the word out, meeting with stakeholders, all the stakeholders of the proceeding, and those that aren't in the room, including CIUC, legislative leaders, really anybody who we can, who we know is involved and concerned for Connecticut ratepayers and our customers, to try to get the word out. And of course, in our communications with our customers, also letting them know of this rate change that is going to occur and what are the drivers. So
Are you getting a lot of phone calls at the company about this in your consumer unit, or just curious?
At the moment, yes, we have been getting few inquiries based on the feedback that we received from the CSRs about the rate increase, the possible rate increase. Okay.
Thank you.
Mr. Rogan, I think I might have a question for you, please. I said that I think it's for you, so I apologize if it's not. I should ask the question. It's about self-supply. And from 240101, I think there's an approximate 1.8 cent per kilowatt hour credit being returned to customers because of self-supply. Is that generally accurate? My question is about the end date of that time period. So is the 1.8 cent per kilowatt hour, is that January to June of 2024, or is there some other time period associated with that?
Oh, there we go. Subject to check with Mr. Shell, it's my understanding that was the GSC true-up question that was asked earlier in the day, whether in CAE 13 we had included that GSC adder in the projection. So that is a projection for 12 months of 2024. There could be a slight adjustment to it into July, December, but for the most part, we expect it to be very close to what it is currently.
Okay, I thank you. I heard the response to that question. So, but the 1.8 cent per kilowatt hour credit, that goes for the full 12 months.
Correct.
Okay, thank you. Mr. Okay, I have a question about call volume and from LiDAR. So, thank you, Mr. Rogan. Mr. Bajan. And Mr. Bajan, I don't know if, I can't recall if it was you who provided this evidence in 17-1203 RE11, which was the docket in which we stood up the LiDAR program, but the company initially estimated 4 to 8 full-time employees at an annual cost of $300,000 to $600,000 in that docket. And what I'm trying to do is reconcile that estimate, which for the record, I'm referring to the decision in 17-1203 RE11, which cites to an Eversource response to interrogatory EOE 25. So what I'm trying to do is reconcile the estimate from the LiDAR decision to CAE 22 in the instant docket, in which there are call handling times, which I'm just the call handling time estimates here do not appear to reconcile to the rationale for the FTE estimates and the underlying decision. So I'm hoping that someone can talk to me about the difference between what's being requested here versus what was contemplated in the RE11 decision.
I believe the RE11 decision and our response in that docket was related to the additional processing of hardship verification.
For tier 2.
For tier 2, yes. So with additional customers coming into hardship, there'd be additional work in our back office to review those financial documents and categorical eligibility forms in order to enroll them in tier 2.
Right. So thank you, Mr. Trainer. And that aligns with the decision that I was just quoting from in RE11. So my question is, the call handling time that's contemplated in CAE 22 seems to just be general questions that have come in, which was not what was contemplated in the RE11 decision. So I'm wondering like what the disconnect is. It just seems like there's two different functionalities.
So the cost that is mentioned in CAE 22 for the low income discount rate, average handle time, that is for when the customers are calling in terms of inquiring about what is the low income discount rate based on the communication that we start to send out, I think July-ish timeframe. And now every time when the customer is coming in, when we are pre-qualifying the customers on hardship, we are giving them the information about how they can qualify for a tier 1 or tier 2. If the customer calls in and they're coded hardship already, how they can get onto tier 1, what's the document needed, what's the tier 2 eligibility. So all that information explaining the usage, explaining the for both the tiers. So all that is adding on to the handle time for the calls that are coming in from the customers.
Understood. And just so I'm clear, what I'm looking at in CAE 22 is just 2 calendar months. These are anticipated to be reoccurring costs under this model. Is that correct?
Yes, that is just an estimate for now, but this is an incremental cost that's going to continue to happen as we move along.
Okay. An incremental cost that was not contemplated in the underlying decision, because let me rephrase as a question. So in the underlying decision, the company estimated that it needed 4 to 8 FTEs to, Mr. Trainer, as we were just talking to align tier 2, to get customers into tier 2 in the event that DSS opt-out sharing did not occur. What I'm hearing you say now for CAE 22 is that the costs being incurred are to answer general questions about how to get into various tiers, because DSS opt-out sharing has in fact come about. Correct? Am I missing something? And
Yeah, so in CAE 22, it's just the cost to answer the phone calls. It wasn't contemplated in RE11. The cost in RE11, what we just did was the back office cost to process the additional paperwork that was going to come in related to LIDR.
thank you. Okay. My last question is about CAE 2 and Mr. Bruno, I think you said something that is actually the basis of my question, so it might be you, sir. So I didn't understand the distinction that you were trying to make between these positions not being funded in base rates. But you later clarified that the energy efficiency positions are in fact recovered in rates, just not base rates. Correct. Okay, they're recovered through.
The CAM and the energy efficiency. So the in the CAM filing that we do, where we apply the CAM for the energy efficiency budget dollars that we go through the CLM process. That's where the rates are recovered from. I'm speaking not to traditional CLMP transmission distribution rates. So they're outside of that.
Understood. And so I think where it first came up was when the authority was asking questions about CAE2 and some of the positions listed in there and whether they are incremental or new. And what I understood to be your response was that some of those positions are energy efficiency positions who are now allocating some of their time to a program being recovered through RAM. Was that an accurate understanding?
Correct.
Okay, so how is that being reflected in CAM? Are you because these are not new or incremental employees, these are employees who are established and being recovered through.
So when we create our annual CNLM plans, we prepare budgets for labor, for estimates for that current year. So if we see, for example, the ESS program, portions of that program were traditionally energy efficiency. There was the demand response program called Connected Solutions. If the trend ends up switching where we're doing more work towards the Connected Solutions program, it would put less labor in the energy efficiency program needed to cover that particular program.
Okay, so CAM is reflected, or CAM is recouped on a different timeline than the RAM components, isn't that correct?
Yeah, Mr. Schultz told me when it was filed, was it February it was filed, I think?
Yes, we file February 1 for rates effective March 1, but the rate is usually always at the statutory maximum, which is a 6 mil rate. And then I think Mr. Bruno can explain how that 6 mil rate gets constructed.
Right, okay, well, Mr. Shawna just tip where I was going. I'm not sure that I understand how we are not double recovering for a position if we were already collecting at the statutory maximum and that position was being recouped through energy
Yeah,
efficiency.
very good. So within the CAM filing, there's also a under over recovery from the prior year actual expenditures. So to the extent that a person that we had budgeted for in 2023 spent more of their time on the PURA docket, we would spend less money in energy efficiency, and that would be part of the true-up process when we do the CAM. So the CAM has basically what were last year's expenditures versus budget, and it puts in the next year's budget. So there's a carry under portion of the CAM. That's how it gets reconciled.
So between the two, you're only ever collecting 100% of the costs. If they're allocating more time to the energy efficiency program, that would be reflected in the reconciliation, and same for here in the RAM.
Okay, and how are you accounting for the difference in timelines with the CAM going March 1st to February and the RAM going May 1st to April 30th? Are they both recovering calendar year expenses?
The CAM is recovering calendar year expenses. And because it's at the statutory cap, there's no real change in the rate.
But an individual can only charge 100% of their time. So between the CAM and the RAM, if they're charging 40% to the RAM and 60% to the CAM, even if the rate changes are on a different cycle, through the reconciliation, you would only ever collect 100% of the cost between the two.
Mr. Horton, thank you. I understood that. I understand that. I wasn't able to reconcile that with an exchange that you had with someone earlier about the vacancy rate. I think it was Mr. Zblowski you're talking with about the vacancy rate and what happens if somebody leaves. And I understood you to say that it would be appropriate to recover in both places because the work still had to be done. So
No, if it's between CAM and RAM, there is no, you're collecting 100% of the cost. If an individual leaves the company and there's a vacancy, so we're not incurring a cost, there would be no cost that's reflected. Regardless of the basis for the way the rate is set, on reconciliation, we would see the fact that there were no labor charges. There would be no recovery through a pure rate reconciling mechanism, period. What I was talking about was the complexities of when you get into base distribution expenses. Again, none of these costs are for base distribution related activities. So the type of work is most certainly not in our base rate recovery. The question I was being asked was, well, if you have an individual who was previously employed by CL&P or our service company charging time to the distribution line of business, and then later moves into a tracked mechanism, could there be the potential for double recovery? And that issue pops its head up all the time when you're talking about incremental O&M recovery for expenses. I was talking about the relationship between tracked FTEs and base distribution FTEs. There would never be the possibility for a double recovery between two trackers because an employee couldn't charge their time to more than one place.
Okay, thank you.
I just had one thing to clarify too. When we did the 2024 known and measurable estimates, you could help me out, Mike Schaus, but those are estimates of the amount of time being charged. So they're not being recovered. We just put together the document for 2024. I don't believe they're in the filing for the rate portion. Is that correct, Mr. Ellis?
That's correct. Those were in the other changes portion of our known and measurable filing. And so to the extent there are costs in 2024, those would be ultimately recovered next year when we go through the reconciliation.
Okay, are you saying that that none of the known and measurable changes are reflected in the rates or just specific for this?
No, so there are a group of known and measurable changes that appear in our table 1 of our known and measurable filing. And those are the ones that we are requesting a rate adjustment for in this proceeding for May 1. However, there were a long list of other changes that we were just making the authority aware of. We don't feel that they necessarily meet a known and measurable standard as we understand application of that standard, but we were making the authority aware that these are changes that are likely to happen in 2024.
Okay, that's really helpful, Mr. Shaughnessy. Thank you. When just following up on that last piece, when you say that you don't think that it meets the definition, can you be more specific why you don't think it meets the definition? Is it because you couldn't quantify, or what do you think in the authority's definition is precluding you from including those in rates?
Well, I would prefer to defer to Mr. Bruno in terms of how his program is going to roll out in 2024, because I think he can explain why those things are not necessarily measurable at this point.
Sure. So for exhibit 17, I believe, and exhibit 18, one is the IES program, one's the ESS program. Both of those are estimates of labor required in 2024 based on predicted program activity. So till we know the actual programs that come through, customers that come through and apply, we'll know more about the actuals. So we didn't use estimates for putting those into rates. We put them in, we put the exhibit together, but for Mr. Sheldon's his overall role, if they're not including those numbers. So when the year is closed, 2024 is closed, we'll put those in for recovery next year. Similar to what we did for 2023 for those particular two programs, IES and ESS.
Okay, thank you. Okay, 1 second, please. Okay, I think my last question was just going back to one of the supplements. The authority staff had asked for the employee breakdown in CAE 2, and we'd asked for a couple of different categories that we wanted that information shown. I was hoping just to add to that the column about the funding source so I could better understand the exchange that we just had. So I think that's my last question. So with that, I'll ask Attorney Pace if you need some time to consider redirect, and after that, we will discuss the administrative matters.
Thank you. Could I have a recess for 5 minutes until 1:55, please, to speak outside?
Yes, we can recess until 1:55.
Thank you.
Oh, yeah.
I literally lost it, they come back here and go try to find it.
I hope so.
Yeah.
Already there.
It's just wherever you're coming from.
Oh, I'm sorry, please.
Thank you. I do have a few questions for redirect examination. I'd like to start first with Mr. Horton. Do you recall the question from Vice Chairman Bekowski where he asked about what are we doing to communicate to customers the rate changes? Can the company provide as a supplement to the record information regarding those communications?
Yes, I can. Thank you. So I mentioned we've done stakeholder outreach and engagement, but we've also created a website, eversource.com/solutions, where we have outlined the solutions that we have proposed and what is coming for customers. It was also a top story in our digital customer update. We have also purchased external advertising to direct folks to look at that new website. Our president, Steve Sullivan, posted that on his LinkedIn page. We've also communicated that through an update with our legislators and other stakeholders. So we're doing the best that we can to get the word out of what's coming, and I expect that we would as well do that as we approach and have clarity around what the actual rate impacts would be. Thank you.
Thank you. My next question is for Mr. Trainer. Mr. Trainer, do you recall the colloquy between you and the chair and Mr. Bajan where you asked to provide context regarding the estimate we gave of 4 to 8 FTEs in docket number 17-1203 RE11 regarding LiDAR? Do you recall that colloquy earlier today?
Yes, I do.
Can you provide any context or clarity in terms of what specifically was the company responding to when it gave an estimate, when it said, we expect between 4 to 8 FTEs for LiDAR? Can you provide the context?
Yeah, so in that response, it was EOE 25 in docket 17-1203 RE11. And what we were responding to in that question was purely the enrollment and identification of accounts in tier 1, 2, and at that point it was tier 3 for moderate income, which didn't end up being approved, and not the calls that it would take for customers with questions. So it's purely the enrollment aspect of the LIDR in what is now tier 1 and tier 2. And both tier 1 and tier 2 have to be reviewed because we don't know if it's tier 1 or tier 2 until the actual review takes place. Additionally, and just for additional context, that 4 to 8 number ultimately was over 30 at one point in the lead up to the LIDR, because so many customers enrolled during our communication program where we had, all residential customers got the email, all financial hardship customers got a communication about LIDR. So that created a large influx of customers coming in to enroll in the LIDR.
Okay, thank you, Mr. Trainer. My final question on redirect examination is for Mr. Horton. Mr. Horton, do you recall earlier today a discussion between yourself and Mr. Capozzi that inquired about carrying charges on the ESI rate mechanism? Do you recall that exchange?
Yes, I do.
Can you provide clarification for the record why it's appropriate for the company to receive carrying charges on the ESI?
Yes, I can. And I touched on this a little bit in the exchange that followed after lunch, but just to clarify, so there are two things at play. First is the weighted average cost of capital, which would apply and does apply for ESI-related capital investments. So as we make investments, we, per the settlement agreement, collect the weighted average cost of capital as well as other capital-related costs through the ESI. Then there's the question of whether or not we have timely recovery of those costs through the ESI, which determines whether or not carrying charges on the collection of that underlying cost should apply. And when we have an under collection of costs for those mechanisms, that's when the prime rate becomes applicable. And just for some additional context, we put this in our response to RSR 5. Known and measurable adjustments for, and we've had a lot of discussion on known and measurable adjustments versus forecasts for our ESI have not been reflected in the ESI since its inception or through the RAM. In 2021, we had proposed a known and measurable adjustment that was not accepted by PURA. The actual result came within $800,000 of what we had projected for a known and measurable change. This year, we proposed a known and measurable change because of all the components within the RAM. We can calculate with relative certainty what the ultimate amount that would be recoverable should be reflected in costs. But by not incorporating that into rates, carrying charges at the prime rate should be applicable because there's a lag that doesn't exist when we're setting base rates on the actual expense for that given period. In other words, if these amounts had been reflected in base rates, there wouldn't be a lag in recovery because base rates would be reflecting to collect the costs that we incur in the period. So when they're pushed off and not accepted into rates on a timely basis, that's when carrying charges must apply.
Thank you, Mr. Horton. I have no further questions on redirect examination. Thank you.
Thank you, Attorney Pace. Okay, if we can have a discussion about supplements.
And Chairman, the only one that I wrote down in my notes for which we asked for special consideration, if it was allowable for a time period beyond 2 days if needed, was the request, I believe, from Attorney Wheel at OCC to the company to provide an update to Exhibit ES1, starting at page 34, where Mr. Horton was asked to provide additional analysis going back to 2019. Mr. Horton responded by saying that not within 2 days. We can provide whatever we have within 2 days, but if there is latitude for that one data response, we'll use the time we have to provide more information. So we deferred to the authority in terms of what time frame would be acceptable.
I really appreciate that, Attorney Pace. On that one specifically, I guess I would like to understand a little bit more. Maybe I didn't understand the exchange correctly, but it sounded like the response, and Mr. Horton, if I'm mischaracterizing this, please step in, but it sounded like the response was made me think that it didn't matter how much time the company had. It wasn't something that you could do because you don't necessarily, since you weren't using forecasts at that time, like to go back and recreate them is kind of like a nonsensical, that's not the right word. Like you couldn't do it because you weren't being asked to use forecasts at that time.
Well, I think we could get it close, but we would need to work through all the assumptions that we'd have to make. It's also complicated by the fact of how rates have been mitigated since that time frame. So if we're looking at what actual rates were in effect, it just becomes complicated. So I think we can do it, but to have, to inform the record with what our proposal would look like, I would want to make sure that we have sufficient time to analyze it.
Okay, thank you. And Attorney Wheel, maybe I'm just not understanding it because I thought your request was that Eversource's table of things that they would have done differently, like what would that have looked like had Eversource's proposals been in effect at the time? And so I just don't really understand if the company didn't have those forecasts saved somewhere to make this point later. I just don't understand what we're getting from having them go back and recreate something that none of us can show without a doubt is what they would have put forward at that time. And I just feel like I'm missing something between this exchange.
I think I'd agree, Chairman. I mean, I think that what I was seeking with my question was to give the company an opportunity to show the authority that its proposals make sense. I think there's a lot of, I mean, I think there are assumptions kind of built into the proposals that are discussed in the testimony. So I thought it would be appropriate for the company to be able to show, well, you know, my understanding of the company's position is that the RAM would work better a different way. And it seems like there's a lot of suggestions that the way it's worked historically hasn't been as effective and would have worked better historically a different way. So, but if the company can't show that beyond what's already in the testimony, then I'd retract my request for a supplement.
Well, just to be clear, I do want to make sure, maybe I'm misunderstanding. We can, I think it's more than just anecdotes where we see there being an analytical basis to make some changes. So we're happy to produce analysis. What you were asking is, can we go back and recast what the rates would have been at that point in time if we relied on forecast for everything? And I think we can do that, making some simplifying assumptions, not in 2 days, but we can, and we can outline what those assumptions are. I mean, I believe there are benefits to making some changes, so we'll produce analysis that shows that. But at the end of the day, it's not going to tell you that this is a silver bullet. There has to be other structural changes to it, and that's the bigger picture point that I'm making. We focused on the key drivers, again, focusing on the bigger picture, being the Millstone and Seabrook contracts. That's what's driving a lot of the changes, driving a lot of the annual swings that we're seeing. So we focused on those, but we can go back and recast the whole thing. We would just need to make assumptions to do it. I still think it's a worthwhile exercise if people are doubting whether or not our recommendations are going to add value and be better for customers.
I'm still really struggling with, like, if okay, you're saying that you would have to recreate and recast what it would have been at the time. The company does not have in its possession a forecast that you would have used at that time because you didn't run the exercise simultaneously to how this was supposed to, or how the pure methodology had you do it. So you would be recreating something with the benefit of hindsight. Is that not the right way to? I'm really just.
We're seeing, I think what I would say, again, if we just take a step back, I think there's a lot of room to collaborate on how can we get to a better solution for customers. So period. That's what we're hoping to be able to do, whether it's part of this phase or the next phase or a separate proceeding. What we're seeing as being on the front lines of this is it's an annual process where we're trying to mitigate bill impacts for customers. So we see structural improvements that we think should be made. I can produce analysis. I think the detail that I'm pointing out is, yes, we don't have perfect forecasts back at that point in time because we didn't produce them. But I don't think that should stop us from looking at customer-oriented solutions. We can just make assumptions. We focus on the two biggest drivers. I think that any analysis we produce beyond that is going to just confirm what we've said, but I can understand their skepticism. We're happy to produce analysis and show you all that we have looked at in reaching our conclusions.
Okay, I appreciate that, Mr. Horan. With that, I mean, that's a little beyond the scope of phase one. It was the scope of 220908. So I'm in the position where I'm not seeing that supplement is relevant to the phase one decision. Attorney, we'll give you a chance to rebut if you disagree.
Not sure I'd disagreed necessarily with the intent of that it's out of the scope of the intent of phase one. I would offer that I think it's relevant to what's being proposed in the testimony. I think this is an unusual piece of testimony for RAM proceedings in that it's addressing sort of a systemic issue that the company perceives, which isn't my understanding normally what's within the scope of phase one. So I think to whatever extent the authority is open to considering that sort of unusual topic within this proceeding, I think it's relevant. I mean, I do think that the authority could assign whatever weight to the supplement is appropriate, given that the supplement, it doesn't sound like it sounds like as the company's discussing it, it would require assumptions and wouldn't be based necessarily on exact evidence. I think from my perspective, if the company could produce something in 2 days and put it in the record, that the authority it wouldn't be inappropriate for the authority to consider whatever weight the authority thinks it has with respect to that portion of this proceeding.
Okay.
May I confer with counsel for 1 second? I just have a process question, if that's okay.
Sure.
Chairman, if I could have a moment, I just want to quickly consult the comments that the company was asked to file in this docket in the January timeframe. And the issues being raised there is, as a result of the scope of those comments, is the issue involving what the recovery period should be, and should there be changes to it within the scope of the proceeding? If I could just have a moment just to be able to call up the notice, Chairman.
Sure, if you'd like. Otherwise, since the Attorney Wheel has proposed a path forward, I'm happy to let the supplement into the record with the authority giving whatever weight it deems credible.
Okay. Thank you, Chairman. That resolves the issue. Thank you very much.
Okay, thank you. And can you remind me, the company was asking for an additional day? What was the request?
I'm going to ask my clients if there's a specific request we'd like to communicate to the chairman in terms of, for that specific request from Attorney Wheel, is there anything beyond 2 days we're looking for, being mindful of the fact that the authority has to issue a decision within a short period of time. So it would have to be a very restricted request.
I think if we could have until Thursday for that one, then we'll put in, the best that we can. I think that would be sufficient.
Okay. All right, thank you. We'll do that. Thursday by 4 p.m., please, for that supplement. The others would be appreciated by Wednesday by 4 p.m. if possible. Attorney Pace, it's meant to be phrased as a question.
Okay.
Sorry, let me say that again. The remaining supplements, is the company amenable to giving those by 4 p.m. on Wednesday?
Yes.
Okay, very good. I think that takes care of the issue. Does the company have any clarification questions on any of the supplements, or you have those written down appropriately?
I'm going to ask the witness panel. We have them recorded, but anybody have any questions before the chairwoman terminates the hearing? The panel does not. Thank you, Chairman.
Okay, thank you. Are there any other administrative matters before we adjourn? Okay, I'm not seeing any, in which case that concludes our agenda for the day. So I thank everybody for your participation, and we are adjourned.